Good morning and welcome, everyone. Welcome to the Thursday, March 28th, 2024, Little Hoover Commission hearing on California homeowners insurance market. This is part one. I'm Pedro Nava. I'm chair of the Little Hoover Commission, and thank you for joining us today. I want to introduce the other commissioners who are here with us. Vice Chair Anthony Cannella, Commissioners David Beyer, Gil Garcetti, Jason Johnson, and Jana Sidley. Commissioner Dion Aroner, I understand, is on her way. We also are often joined by the legislative staff if legislators cannot attend. So our legislative members are Assembly Member Philip Chen, Senator David Min, Senator Scott Wilk, and Assembly Member Liz Ortega. Commissioner Jose Atilio Hernandez planned on participating today, but due to a change in his flight arrangements, he will be unable to do so. With us today is Commission staff, Executive Director Ethan Rarick, Deputy Executive Director Tamar Foster, Analysts Ashley Hurley, Ali Powell, and Shara McAllister, Project Managers Crystal Beckham and Daniel Harris McCoy. I've got to do a little bit of housekeeping before we turn to our subject. Immediately after the hearing, the Commission will hold a business meeting. That business meeting is open to the public, and you're welcome to attend should you care to. We're also live streaming today's hearing and business meeting on Zoom and are being joined by members of the public who are attending remotely. They will be muted during the course of the hearing. We will have a public comment session at the end of the hearing. If you're here with us in person and you want to make a public comment, please fill out a public comment slip and give it to one of our staff members. Members of the public who wish to make a public comment on Zoom will be unmuted during that public comment session. If you'd like to make a public comment, please use the raise hand feature in Zoom by clicking on the hand icon and join our public comment queue. Those who have joined us by phone, you may either dial #9 to raise your hand or send an email to littlehoover@lhc.ca.gov, letting us know you want to address the Commission. Please provide your phone number from which you have joined the meeting so that our staff knows who to unmute. Staff will be monitoring raised hands and emails requesting comment throughout the duration of the hearing. As is usual at Commission hearings, public comment is limited to 3 minutes per speaker. The audio and video of our hearing witnesses will be turned on when they make their presentation. We're recording today's hearing, and after the hearing, staff will place a permanent link to the recording on our website and upload it to our YouTube channel. And now to the substance of today's hearing. Today is the first in a series that will examine California homeowners insurance market and explore potential reforms that may be needed. This is an issue of great importance to many Californians. News reports frequently recount how insurance companies are failing to renew policies or are not writing new policies. Many Californians, including some of the experts' staff have interviewed, have faced the frightening prospect of losing insurance for their most valuable possession, their home. This is not merely a California problem. Other states, especially those that are prone to natural disasters, have faced many of the same issues. Today's hearing will help frame the current state of the California home insurance market and will feature witnesses' testimony from consumer advocates, a leading industry executive, and a former California Insurance Commissioner, Dave Jones. You should know that former Insurance Commissioner Steve Poizner wanted to attend and participate at this meeting, but had a scheduling conflict. We will be working with him to hopefully provide an opportunity for him to offer his thoughts as well. I do want to note that we did invite the current California Insurance Commissioner, Ricardo Lara, to testify, or someone from his office to testify at today's hearing, but those requests were unsuccessful. We hope that the Department of Insurance is able to testify and participate at a future hearing on this topic. I want to thank Commissioner Sidley, who serves as the chair for the subgroup that's working on this, along with Vice Chair Cannella, for their leadership on this topic. Now, before I ask Deputy Executive Director Tamar Foster to introduce the first witness, I've had a request from one commissioner for the opportunity to make a statement. Commissioner Garcetti.
Thank you, Chairman. I'm going to say something because this morning I was inspired. I was inspired because even though I've been to Sacramento many, many times, I'd never taken a walk. I've taken a walk in the Capitol Park, and today I did. And the reason I mention that is because I'm probably easily the oldest person in this room and maybe even in our audience. Born and raised in Los Angeles. I have been politically active most of my life, and I have never been, I think, a witness or alive during a more difficult period of time in my life. Certainly, I'm not just talking about politics, but the climate, the economy, and maybe the future of democracy, frankly. And it's easy to get down on the challenges we're facing because they all seem to be almost insurmountable at times. Well, take a walk today or tomorrow, and I mean it. Take a walk today or tomorrow in the Capitol Park, and your spirits will be lifted because you will see magnificent specimens of what nature has given us in the trees and the flowers, the cacti that are there. You'll see orange trees that are larger than any orange trees I have ever seen in my life, full of fruit. You'll see the cherry trees in full bloom. You'll see other trees in full bloom with vibrant colors, and it's going to bring a smile to your life, and it's going to make you feel better. And when you walk away and you walk by a stranger, always trying to have a small smile on your face and maybe even say good morning with a smile. Maybe it'll help change them, and it'll help you too. Thank you for listening. This has nothing to do with the Little Hoover Commission, but I just felt inspired by this morning. Thank you, Commissioner.
Thank you, Commissioner Garcetti. And just let me add to that, that seems that it would be appropriate segue to give thought to the select committee or the special committee that is chaired by Emeritus Speaker Rendon on the issue of happiness. And I think part of what he is trying to get people to focus in on is as dire as times may seem, that we are surrounded by things for which to be grateful for, and that initiate happiness. So thank you for those thoughts. And with that, I'd ask Tamar Foster, would you be so kind?
Thank you, Chairman. Good morning, Commissioners. Our first witness today is Dave Jones. He is the Director of the Climate Risk Initiative at UC Berkeley Center for Law, Energy, and the Environment. Previously, he served 2 terms as California's Insurance Commissioner and also served in the State Assembly as a Sacramento City Council member and as Special Assistant, then Counsel to U.S. Attorney General Janet Reno. Good morning, Commissioner. You may begin.
Good morning. Mr. Chairperson, Commissioners, hoping you can hear me.
Yes, we can hear you.
Well, it's an honor and privilege to get to join you this morning. And with your permission, I'm going to share some slides to help guide me through the presentation that I'd like to make to your commission today.
Absolutely. I'm assuming you've already coordinated with staff. And it's a pleasure to see you again, my friend.
And you too. So hopefully those are visible on your screens.
Commissioner, they are not visible, however. I see. So they are visible on the Zoom. Okay. Unfortunately, Commissioners, they are visible behind us, but not on the, is it possible, Shara, to put those that on to these monitors?
We have to have the Amy come in.
I
don't think that we can.
We would have to pause for a few moments. I apologize, commissioners, or commissioners can turn around and, okay, and look at them on the large screen right there. So I don't know if Commissioner Johnson is going to be able to see those. Okay. Yes, Commissioner Jones, we've worked it out in the room and they can see those slides now. So please go ahead, sir.
Terrific. Well, thank you very, very much. And I really appreciate the opportunity to spend some time with you this morning. And thanks for convening this important hearing. I also want to make sure I can actually advance these slides, which I'm now having some difficulty doing despite having been able to do so a moment ago.
Commissioner Jones, we have the slides, as you know, and we can do that here if you would like us to.
I think I've got it under control, but thank you very much. So what California and other states and territories in the United States are experiencing is extraordinary challenges to insurance markets, driven significantly by our failure as a country and our failure globally to reduce greenhouse gas emissions. And scientists are currently expecting that greenhouse gas emissions are going to drive temperature increases above 2 degrees Celsius. Recall that the global goal was to try to keep temperature rise below 1.5 degrees. As a result, climate change is driving more severe and frequent weather-related events, which are causing more deaths, injuries, property damage and destruction, and insurance losses. This includes coastal flooding, river flooding, drought, extreme heat, severe convective storms, or what's also referred to as atmospheric rivers, hurricanes and other wind events, and of course, in California, devastating wildfires. Another contributing factor to insurance company losses and challenges for insurance markets is the growth of population and businesses in the very areas where the risk has been growing due to climate change driven severe weather related events, and increases in values of the homes and businesses in those areas, and also the increased cost of replacing those homes and businesses is a contributing factor with regard to losses and insurance losses in particular driven by climate change. But we also have something that's contributing to this as well, and this is oftentimes not as well recognized as it should be, but that is in the West, in California and the West at large, the forests in California and Western states have not been managed the way that nature used to manage them before Western settlement and the suppression of wildfires. So previously, the way that nature managed our forests was fire was a routine and regular part of the ecology. Fires would ignite in forests, they would burn out low-level vegetation, smaller trees, and our forests were characterized more like the forest shown on the right, which is wider spaces between trees, not as much vegetation on the ground, not as much low-level trees. But as a result of Western settlement, genocide against tribal peoples, suppression of cultural burning, and suppression of fire in forests generally, our forests now look like what's on the left, which is forests that are choked with fuel and are a contributing factor with regard to the severity of wildfires, which in turn are being driven by climate change. So that's a component of the problem we face in California that I think it's important to underscore that oftentimes gets overlooked. So I believe we're marching steadily towards an uninsurable future because we're not acting aggressively and fast enough to reduce greenhouse gas emissions globally and in this country. Some of the ways in which this is manifest, this is a chart that was put out by NOAA, which reflects the incidence of natural catastrophic events that exceed $1 billion in losses. And as you can see, the trend is not good. And in 2023 alone, we had 28 events, individual events that exceeded $1 billion in losses. These included wildfires, but also significantly severe convective storms. That's the green bar, was a major contributor to the events that exceeded $1 billion in losses. And this is just in the United States alone. This phenomenon is occurring globally as well, and it's landing on the balance sheets of insurers because they are also suffering losses as a result of these events. We're not alone here in California. This is another NOAA chart that just looks at the billion-dollar weather and climate disasters in 2023. They're distributed across the United States. You can look at prior years and see other states that have been hit by them. And so this problem with varying levels of acuity is happening across the United States, not just in California. In California, though, we've seen a growing danger associated with wildfires. If you look at this chart over the last, say, 10 or 15 years, we've seen an increase in number of acres burned. While things have gotten slightly better in recent years, not shown in this chart, the trend line continues to be a growth in the annual acreage burned due to California wildfires. What that has caused then is insurers responding rationally and doing two things. One is raising rates, and two is limiting their exposure by either not renewing insurance or not writing new insurance. And this chart shows over time the increase in non-renewals and cancellations that have been occurring. It stops a little bit short of the present, but that trend line has continued to grow. And we've seen a higher incidence of non-renewals occurring in California, principally in the areas at greatest risk of wildfire. Another measure of the canary in the coal mine that insurance represents with regard to climate change is the number of policyholders that have been forced onto the FAIR Plan. As you know, the FAIR Plan is the insurer of last resort. 37 states have FAIR Plans. They are basically statutorily created involuntary associations of the insurers that are writing insurance in a given state. They're not a state agency, typically. They're not state taxpayer subsidized. State laws, including California's, require that their rates be risk adjusted. And they are the place where homeowners go, and businesses, if they can't find insurance on the private market. And in California, we've seen a dramatic increase in the year-to-year number of policies. Currently, the policy count for the FAIR Plan is about 370,000 and climbing. Now, to put that in perspective, although for those that are accessing insurance through the FAIR Plan, they're not happy about it. They would prefer to have a private insurance product, and the FAIR Plan is expensive because, again, these policyholders are the highest risk that the private carriers have concluded that they can no longer cover. But just to put in perspective, currently, the percentage of FAIR Plan policies as a percentage of the overall homeowners insurance market is 3%. It's not a good place to be, but it is important to put in perspective where we are. It's continuing to grow, but currently just about slightly over 3% of the overall market. And this chart reflects that, stopping a little bit short of where we are today, but today we're at about a little bit over 3% of the total market is FAIR Plan policies. Now, the other thing that's happened that is incredibly important to note is that a number of insurers have announced that they are going to restrict or pause the writing of new business. As of the date of this chart, it was about 7 of the top 12 insurance companies. There have been more that have made that announcement. I do want to note that there's a distinction between pausing business and selectively non-renewing, which is occurring as well, and leaving a state entirely. There's only a handful of very small insurers that have left the state entirely versus Florida, where there have been quite a few insurers that have not only not writing new insurance, but they're not renewing any insurance and they're leaving the state entirely. Thankfully, in California, there's been this pause or restriction on new business. We've only had a handful of very small insurers say, that's it, we're leaving entirely, although that's not a positive development by any means. The insurance commissioner has proposed an insurance sustainability strategy. I'm sure the department will brief you on that if they haven't done so. But the thrust of that strategy is laid out here, which is to try to increase insurance availability in at-risk areas by requiring insurers to write there commensurate to about 85% of their market share elsewhere, trying to move FAIR Plan policyholders back to the private market, and then allowing insurers to use forward-looking probabilistic models or catastrophe models with regard to setting their rates. And here I think it's important to note that the commissioner just released a regulation on this very topic about 2 weeks ago. We could do a deeper dive on that, but what's noteworthy is that the place that the commissioner landed was to allow CAT models to be used for the catastrophe load adjustment associated with developing the rate. So not the whole rate development, but the portion of the rate which is to be calculated to try to capture the catastrophic events that have been happening, sadly, with more regularity in California. As well, the commissioners proposed making some changes to FAIR Plan to raise coverage limits so that it's $20 million per multifamily structure. This has been an issue that the California Building Industry Association has raised and that the commissioner has indicated that he plans to address. As well, he's proposed updating the timelines for the review of rates under his regulatory authority. There's a separate regulation that he issued to try to accomplish that. There was a workshop on that earlier this week, and some improvements to or changes to the rate filing procedures, which seem to be principally designed to try to increase transparency, but also move things along faster. And then I think also critically important is a proposal contained within this strategy to allow insurance companies to include in their rates the cost of reinsurance, which is something that historically California has not allowed. It is a point of controversy, as are other elements of this proposal. I'm sure you'll hear from speakers pro or con later in the hearing. So that's the gist of the proposal, but Florida. And so I think it's important to take note of what's happening in another state, which has also been incredibly challenged in terms of climate change driven losses. In Florida, it's hurricanes and wind. And there's been a higher incidence and greater severity of these events in Florida, which is also slamming the insurance market in that state. And I think it's important to note that in Florida, for example, they've had a significant increase in the number of billion-dollar events and the cost of those events as well over time. And Florida too, because insurers are challenged in Florida and have concluded that they cannot make a profit writing homes and including wind risk, have been in various ways either non-renewing or leaving the market entirely. And that's driven more policyholders in Florida, their version of the FAIR Plan, which is called Florida Citizens. And this chart actually falls a little bit short of the present numbers, but the present policy count for the FAIR Plan, if you will, in Florida is about 1.3 million policyholders. It represents a much larger share of the market there and reflects how deeply challenged the insurance market is in Florida. I think the other important point to note is that many of the things that are being asked for by the insurance industry in California, some of which are included in Commissioner Lara's insurance sustainability strategy, are also things that have already been done in Florida. For example, Florida has allowed forward-looking probabilistic models for pricing or rating for many, many years. It's included reinsurance costs and rates for many years. It also recently decided to limit assignment of benefits, eliminated one-way attorney's fees, tries to reduce the ability to sue insurance companies. It also has created two public reinsurance facilities, taxpayer funded, that are designed to create public reinsurance to help reduce that cost of private reinsurance to the direct writers. And Florida also some time ago enacted a law which changed the structure of their FAIR Plan so that instead of insurance companies being on the hook if there's a shortfall in their FAIR Plan, all Florida policyholders are on the hook for a surcharge. They call it the hurricane tax in Florida. California's FAIR Plan currently is structured, as are most other FAIR Plans in the country, but for Florida and Louisiana, where if the FAIR Plan has a shortfall in reserves, it then surcharges insurers. And I think it's important to note too, that is by design. FAIR Plans, including the one in California, are not required to have the same level of reserves as an insurance company. They're not an insurance company. Rather, by statute in California and other states, they're structured to have enough in the way of reserves to cover average years. But if they are unable to cover catastrophic events that land on their balance sheet, then they're able to surcharge the insurance companies based on their respective market share in the state. That is a major point of controversy with the insurers in this state and elsewhere, who are concerned about their exposure to a potential shortfall in FAIR Plan funding. But it's important to note that that's how the FAIR Plan was set up. And in good years, the FAIR Plan in California has actually paid profits to insurance companies when it's had too much in the way of collected premium necessary to cover average years. In Florida, however, they've shifted that so that in the event of a shortfall, it doesn't land on the backs of insurers, it lands on the backs of policyholders, something the insurance industry had requested there. So rates in Florida about 3 times the national average, and Florida is trying to do a depopulation program. So all the things and more that are being considered in California are things that Florida has already done. And here's the bad news. Until very recently, insurance companies have continued to report net underwriting losses in Florida, despite all of these changes. Now, things got a little better in the first quarter of this year, and things are starting to get a little better in Florida. But I think the jury is still out whether all of these changes and more that have been done, that have been asked for in California and done in Florida, are really going to be sufficient to turn the corner. And why is that? Because the underlying driver of risk and loss is climate change, and it's only getting worse. And there are things that can be done in the short term and midterm, like those proposed by Commissioner Lara, like those proposed by others, which may help in the short term and midterm by giving insurers more rate, by reducing their costs, by expediting rate filings. But my concern is that ultimately, as seems to be the case in Florida, that's going to be overwhelmed by the driving background increase in risk and loss due to climate change. So again, as I said a moment ago, some recent improvement in Florida, but again, Florida Citizens still has about 1.3 million policyholders. They're working to try to depopulate it. But just about 5 months ago, farmers announced in Florida that not only were they not going to just pause writing new insurance, as they've said in California, not only were they going to selectively non-renew, as they've done in California, but they were pulling out of the Florida market entirely. They're not going to renew any insurance, and that's auto, home, and umbrella, and they're not going to write any new insurance, and they're out entirely. And that's notwithstanding all of the changes that Florida has done to give insurers more rate, to reduce their costs, et cetera, et cetera. And so, again, the underlying risk driver may very well overwhelm in California some of the changes. But what can we do in California?
Mr.
Yes.
Jones, I'm going to interrupt you. I'm sure you're familiar with what happens at the commission, is that presenters will often be interrupted by commissioners because you've prompted questions, and I'd appreciate it if you would take that as a compliment. And I have two commissioners who want to talk to you, Commissioner Sidley, followed by Commissioner Cannella.
So, Mr. Jones, this is Janice Sidley. Thank you so much for your testimony today. I greatly appreciate it. I'd like to, as you continue to move forward, and particularly, what we can do in the future, I'd like you also maybe to address homes that are not in these high-risk areas. I can speak personally. I just got a non-renewal notice for a home that sits in basically in the middle of Los Angeles. No fire, no flood risk, no nothing. Satellite flying over the house, looking at a rooftop and saying that a flat roof is not insurable. It is obviously something that you can build you can get a permit and build a home with a flat roof. And candidly, I'm about the fifth person that I know who's received this non-renewal type notice for the same thing, where a satellite is looking at homes. So I certainly understand the focus, and the Little Hoover Commission did a study a few years ago about how the Sierra Nevada was not healthy and the forests were not properly maintained, and based on a lot of research done at UC Berkeley, and we visited the forest that they were examining there. So I totally agree with what you're saying and the premise about how our forests aren't properly kept. But I'm wondering why the insurance companies are sort of now pulling out of those that are actually paying the bills for them to pay out when there's a claim in these other areas that aren't high risk. So I'm just wondering your thoughts on something of that nature.
Absolutely. So insurance companies are updating the models that they are using, catastrophe models, risk score models, for underwriting. And it's important to distinguish between rating and underwriting. Rating is under the control of the insurance commissioner. Underwriting, the state has decided, is almost entirely within the discretion of the insurance industry. And California's not alone in that regard. And so insurance companies are improving their models, adding more data and more experience to the models. And the models are indicating that homes in areas that traditionally may have been renewed, that seem to be outside of, and are in fact outside the high wildfire risk area, nonetheless have more fire risk. And so that's essentially what's happening. And I know you'll have an opportunity to hear from Rex Frazier, who's the CEO of the Personal Insurance Federation, and an opportunity to explore that question more with him. But that essentially is what is happening. And then also because insurers are looking across the entirety of their state and their exposure across the entirety of the state, there's some reflection of what's happening across the entirety of the state occurring with regard to specific areas in California. Now, they do have the right under California's current rate regulations and those that are proposed by Commissioner Lara to assign rate relativities based on probabilistic modeling and to essentially load more rate into higher risk homes and less rate into lower risk homes. And so that's within their capacity to do. But you're talking about underwriting, which is the decision whether to write or renew the home. And those models are being updated and leading insurers to conclude that some risks that they wrote before are just too risky.
Vice Chair Cannella.
Thank you very much, Mr. Chairman. Commissioner, thank you so much for being here. Really appreciate your experience and wisdom in this matter. But I have a question. I was reading the report on the comments that Rex Frazier is going to make when he's on, and he mentioned that when you were insurance commissioner, they requested an increase of roughly 7%, and at the end of whatever the process is you guys use, you actually told them to decrease their insurance rates by 7%. And I'm just curious because, climate change, I'm sure almost everybody in this room would say it's settled science. It's been settled science for a long time. I think we've been able to forecast some of these problems. I'm just curious what your thought process was when we kind of knew that and you wouldn't give them an increase, but you decreased it by 7%. Can you walk us through kind of because I think that applies to what's happening with the current insurance commissioner now. So I'd like to just understand your thought process.
Sure. You'd have to tell me which rate filing that was. I mean, we approved literally hundreds of rate increases and reviewed hundreds and hundreds of rate filings during my 8 years as commissioner. So which
well, do you recall when you asked them to decrease their rates by 7%? Because I don't know that you did that numerous times. I wouldn't imagine.
Yeah, I'd have to know which company to be able to, and I'm happy to talk to you offline, but generally the way that rate regulation works currently in California is that companies are entitled to come in as many times in a year as they wish. They're able to present information with regard to their experience. There is a catastrophe load factor in the current rate development process that provides an opportunity to increase the rates based on some reflection of past catastrophes. And they're allowed to use probabilistic modeling with regard to setting rate relativities. There's no question that over time, the problem has gotten worse. The loss experience in 2017 and 2018 was considerable, and that certainly is informing the rate filings that have occurred since I left office, as well as the commissioner's decisions to approve rate increases. But we improved rate increases, we modified rate increases. We did it based on the regulations.
Okay, thank you.
Commissioner Byer, followed by Commissioner Johnson.
Thank you, Commissioner Jones. Your testimony is cogent and thoughtful and much appreciated. I want to take you back almost 400 years and for a purpose. It's 1652 and there's a coffee house in London and it's a heyday of international exploration. And the coffee house owner, Lloyd's, the Lloyd family, decides to set up an insurance business. And you would think that they would try and to take into account the risk to the ships that were going in and out of London. And if you were doing that today, there's some things that you would think about. One of them is reinsurance, which Lloyd's obviously offers today. You think about what kind of data you can use and what kind of assumptions you should make in either setting rates or determining underwriting rules. So what I'm going to ask you about is whether you think the current California insurance system is sufficiently modern to take into account the climate risks, and there's a series of questions here, the climate risks that we face as a society. And second, whether the insurance department takes enough cognizance of the factors used by companies for renewal or non-renewal. As I understand it, they don't seem to collect that information in a detailed way. So and I've got more questions along the same line, but writing on a plain chalkboard, what should the Department of Insurance be asking for that it's not getting? And what tools should insurers be able to avail themselves of to deal with catastrophic risk, things like self-insurance?
Well, that's a great question. And as I was about to get to in my slides, I do think that there should be changes made to the catastrophe factor in the rate regulation to account for the increase in catastrophic loss. And the way that Commissioner Lara has proposed addressing that is by allowing insurers to use probabilistic forward-looking catastrophe models for purposes of calculating what that catastrophe load should be. And in my presentation, I also suggest that there should be consideration given to allowing reinsurance costs to be factored into the rate. And that's something also that Commissioner Lara has proposed. But I think it's important to understand that there is a difference between rating and underwriting in the sense that the commissioner has been authorized by the state of California to regulate rating, but underwriting he does not have authority over. And so the models that the insurers are using with regard to deciding whether to write or renew, which are becoming increasingly sophisticated, but also have some shortfalls, are not within his purview. That would require state legislation to change. And one of the omissions in those models on the underwriting side is that they don't currently account for the billions of dollars that California is spending on forest treatment. The state of California has appropriated $3.6 billion for forest treatment. Local governments, homeowners associations, fire protection districts are doing forest treatment. There was about $6 billion in the National Infrastructure Bill for federal lands, some of which will land in forests in California. So all of these billions of dollars that are being spent on forest treatment are not being accounted for in the models that the insurers use to decide whether to write or renew insurance. And that's a problem. And it's a problem that can be corrected. In a paper that the Nature Conservancy and Willis Towers Watson jointly published in 2021, we demonstrated that it's technically feasible for the underwriting models to account for the risk reduction benefit of forest treatment. And those results were replicated about a year later in a separate study done by Moody's RMS and the American Forestry Foundation. So that is one change, to answer your question, that I think should be made. I think the legislature needs to require that the underwriting models, which are used by insurers, account for forest treatment, but don't stop there. The insurance industry itself has done some terrific work demonstrating that home hardening and defensible space dramatically reduce the risk of loss too. And so I believe the legislature should require that models, the underwriting models, again, that are used to decide whether to write or renew the insurance, account for forest treatment as well as home hardening and defensible space.
Thank you for the sophistication of your answer. It seems as though you're implicitly calling for greater transparency in the underwriting process. That is, instead of a black box used to determine underwriting decisions, insurers should be more upfront about what information they're relying on, and you're suggesting that they take into account more data in the underwriting process, the forest management spending by the state and federal government as an example. Are there other things that you would write into law that would improve the consumer experience for homeowners so that people have better idea of what they personally can do to harden their home to prevent a risk and to take advantage of financial incentives where their rate could get adjusted if they undertook certain actions, or at least there'd be greater transparency as opposed to the assumption that it's a drone picture that's making an insurance determination, which sounds like algorithmic justice or injustice.
Well, again, I do think more transparency with regard to the models used on the underwriting side is positive. There has been legislation enacted that gives consumers the ability to ask for the risk score that a model has spit out for their home. And also those risk models are supposed to be included as a part of rate filings as well, but the commissioner has no regulatory authority over the content of those underwriting models. So I think more transparency can be good, but I think we've got to go beyond more transparency, and we need to make sure the models themselves are accounting for the billions and billions of dollars that California taxpayers are investing in forest treatment, the billions of dollars that federal taxpayers are investing in forest treatment, the hundreds and hundreds of millions of dollars that homeowners associations, local governments, counties, fire protection districts are investing in forest treatment. With regard to home hardening and defensible space, there is a wealth of information about that. I believe that local fire officials and local government officials do a reasonably good job of informing residents about what they should be doing. In some cases, with regard to, in some areas, it's actually a condition precedent to being able to sell your home that you're given information with regard to its compliance with home hardening or defensible space requirements. So I think the information is out there, but we need the insurance models to account for it so that consumers see the benefit of making investments in home hardening, defensible space, and their investments as taxpayers in forest treatment.
Thank you. We got Commissioner Johnson.
Yeah, and Mr. Jones, to pick up on that, I appreciate your comments around the forest management costs and how those are distributed. I serve on the board of the Napa Land Trust, one of the largest land trusts in California, and we spend a considerable amount of money thinning the forest that we own. Now, separate that from the land that is under a conservation easement, in which there's this discrepancy on whether the land trust is responsible for thinning those forests or it's the actual original owners of those conservation easements and whether they're responsible. And I think there's some questions and challenges there that need to be addressed. Setting aside all of the costs associated with forest management, which as you point out is significant and needed and questionable on how much you can actually do. But I'll save that debatable question. What question I want to ask you, Mr. Jones, is what are the risks associated with insurers pulling out of California? What is the possibility of that, and what is the consequence of that long term? Can you describe that to us? Help us understand that.
Certainly. I mean, as I said earlier in my remarks, I think we're marching towards an uninsurable future, not just in California, but across the United States, with different levels of acuity based on the impact of climate change-driven risks. And so the challenge for not just California, but for every state with different levels of acuity is that the United States and globally, we're not doing enough to transition away from fossil fuels and other greenhouse gas emitting industries. And there's a role the insurance companies could play in this regard too, which I didn't have a chance to get to, but that is insurers collectively in the United States are investing $569 billion in the fossil fuel industry. One has to ask the question, why is the insurance industry investing in the very industry that's the main emitter that's causing temperatures to rise, which is causing climate change, which is causing more frequent and severe weather-related events, including more catastrophic wildfires, that's making it increasingly challenging for them to write insurance. So too, why are they insuring that industry? So there is a contribution the insurance industry could make to trying to reduce the growth in global temperatures by helping us transition away from those very industries which are contributing to that. But my concern, the concern that I'm trying to leave with you is that while there are short-term and mid-term policy changes, which Commissioner Lara has proposed, which others have proposed, which Florida has already undertaken, those may help in the mid-term and short-term to provide insurers more rate, to provide more rate more quickly, to enable them to lift the pause on writing new insurance and potentially begin to, in some cases, selectively renew in the higher wildfire risk areas. Those short and midterm policy changes may very well be overwhelmed by the increase in background risk associated with climate change and forests choked with fuel. So I know that others are going to kind of get into the weeds with regard to what are the specifics in Commissioner Lara's proposal. I think that's terrific. But what I want to draw your attention to is the background drivers of the risk that are continuing to occur that we need to address. And one of them is very much within our control, which is forest treatment, which we know reduces wildfire risk. And we know that the models don't currently account for it. I'm going through my slides now. We know that billions are being spent on it. And you referred to it as costs. We're actually literally spending billions of dollars, $3.6 billion from the state of California, billions from the federal government, hundreds and hundreds of millions locally, And yet right now consumers are not getting any measure of benefit from that in the underwriting model. So I think one of the solutions is make sure the underwriting models and the rate models include the risk reduction benefit force measure. Now, Commissioner Lara, to his credit, in his recently released proposed regulation on allowing probabilistic models to be used for the catastrophe load adjustment, has included language that says that if those models are used for the catastrophe adjustment in rates, they need to consider landscape scale, mitigation, home hardening, defensible space. That's terrific, right? But on the underwriting side, you don't get to the rate or the rate discount, which he's also done about 2 years ago, a rate discount for home hardening, defensible space. But you don't get to that if they won't write you the insurance, right? And that's why the legislature needs to pass a law that requires that the underwriting models account for those things too.
Thank you, Mr. Jones. Look, I know how you work and I appreciate you taking the questions. I do understand. Let's get back to your slides because you're making some points that I think are different from what we're likely to hear from some of the folks on the panel coming up. So if you'd like to continue, please do.
Well, I think I used the opportunity presented by the commissioner's questions to walk through what I think we ought to be doing. And so, again, just try to drive home the point that there are short and midterm changes that might improve the situation in California. And there's going to be a robust debate about those both before your panel by later speakers, as well as in the context of Commissioner Lara's proposed regulatory changes. But I want to draw your attention back to the underlying drivers of risk, climate change and forests choked with fuel. Now, the other issue too is we continue to encourage more people and businesses to locate in the high-risk fire areas. That's a contributing factor as well. And so doing more to try to disincentivize that as best we can, as well as to continue to increase code requirements as they relate to building codes and home hardening and also defensible space are all important parts of the tool set too. But even though more people continue to move into these high-risk areas and more businesses are there and the values at risk are higher and the cost of replacing homes and businesses is higher, we wouldn't be as in great a dire situation if we didn't have more frequent and severe weather-related events driven by climate change and more severe catastrophic wildfires driven by forests choked with fuel. So I keep coming back to those two key risk drivers as things that need to be aggressively addressed in addition to short-term and midterm policy changes.
Thank you. I have Commissioner Byer wants to engage again, but I'm remembering you and I served on the Wildfire Commission that was addressing some of the issues that related to wildfires in California, and part of what drives experience and exposure, as you and I, sort of both embraced, are local land use decisions. Now, agree with you with respect to forest management. I mean, we learned that the federal practices that started like in 1918 contributed greatly to the problems with our forests. And I think it's important that we remind people that the majority of the forest land in California is owned by the feds. The state of California has direct responsibility for about 3% of it, 3 to 4% of it. And so that's something that we have to unwind. But let me turn to Commissioner Byer.
Thank you, Commissioner Nava. Commissioner Jones, I'd like to ask some kind of mechanical questions because I don't know a whole lot about insurance, but I've read about it. I'm insured. And what I'm trying to get at is the rate setting process of who the parties are. There are insurance companies and they're well represented and they have lawyers and they have accountants and they have statisticians. And then there's something called, I guess, interveners. And those interveners are paid for by the insurance companies through a fee. And so you have kind of professional opponents and professional rate seekers. Is that process the same in virtually all of the 50 states? And does that process lead to either lack of certainty or lack of timeliness just by definition? In other words, is there a better way to essentially adjudicate fact disputes as opposed to policy disputes, which could be resolved by the legislature. Is there a better way to do this?
So I apologize because I have a hard stop at 10:50, but rate regulation is done differently in different states, but all states and territories have some mechanism for the rates to be filed, be reviewed, and then a determination made by the commissioner as to whether the rate will be approved or be adjusted. California has a history of more public processes that invite the public to participate, and that is true with regard to the voter enacted Proposition 103, which provides that there is an opportunity for public interveners to intervene in the rate process. It turns out that it's very, very challenging for just anybody to do that. You have to be fairly sophisticated. You have to have sophistication with regard to rate analysts, actuaries, lawyers to do that. And so there are a number of entities that do it, one principally that has that expertise. My own view is that that has added a lot of value in the process. That doesn't mean that there aren't changes that can be made to the process to try to include, increased transparency and move things along faster. But there's no automatic payment of interveners in the process. They have to have added value. If they don't add value, then the commissioner shouldn't be approving fees for them. But it is structured because it's so expensive for the public to intervene that they can recapture their costs of intervention. And the reality is that this is very, very sophisticated stuff, and you need to have experts do it, and experts are expensive. I apologize to the commission. I know we started a little bit late, but I'm going to have to decamp, but I'm happy to engage one-on-one with commissioners or come back another time.
Well, let me thank you for your generosity. I know from talking to staff that you made yourself available and already spent a fair amount of time giving them the benefit of your background and your experience. And speaking on behalf of the commission, we're very grateful that you took the time to be with us today.
Thank you very much, Mr. Chairman. Thank you, commissioners.
So next witness, please. And let's welcome Commissioner Dion Aaroner, who joined us. Welcome.
Thank you, commissioners. Our next witness today is Carmen Balber. She's the executive director of Consumer Watchdog, which is a nonprofit consumer advocacy organization. Previously, she directed Consumer Watchdog's Washington, D.C. office, where she advocated for key health insurance market reforms. She's been with the office for nearly 2 decades. Good morning, Carmen. Thank you for being here.
There we are. Now I'm lit up. Good morning, commissioners. Thank you for the invitation to be here. As Tamara said, I'm Carmen Balber, Executive Director of Consumer Watchdog. And I wanted to focus on laying out the current state of the market, clear up some of the misinformation that is out there, and talk about solutions that will help us restore access to affordable insurance for Californians. If you can go to the first slide. We are all very familiar with the fact that we had 2 massive fire years in California, 2017 and 18. Insurers had huge losses. What they don't like to talk about is the fact that they recouped a lot of those losses from the utilities who were responsible for a number of those large fires. PG&E alone repaid $11 billion to the insurance industry for their role in the 2017-18 fires. And if you can move on to the next slide, insurers in California, contrary to the story they tell the public, have done as well as or better in California than they do nationally. And these numbers are from the National Association of Insurance Commissioners. There are various measures of insurers' income and profits. The bottom one is the most comprehensive because it includes not only what they're spending and taking in, but their investment income. And California's return on net worth was 2.5 points higher over this 20-year period than the national average. So California is doing better than the country. And if you can move to the next slide, this plays out in the most recent years we have data for. Just looking at the years right after those fires, the gap is much larger between how much better California is doing than the nation. And these are tiny, but you can maybe flip to the next slide just to focus in on that return on net worth number. If you see 2019, 20, and 21, which are the most recent years that have been released, California's return on net worth in the homeowners insurance line was 19.4% compared to 1.3% nationally. So the narrative that the insurance industry is going broke in California because of the specifics of our state and our regulatory system, which is really their target, is some misinformation. In fact, I wasn't able to insert this piece in the slides, but the most recent example of an insurer targeting California is State Farm's announcement last month that they were dropping 72,000 homeowners. We looked at State Farm's numbers for the last 3 years, so 21 through 23, and compared the returns of the California Home Insurance Company and the one that covers everyone else across the country. And the loss ratio, which is the best number we have access to right now, in California was 62.5%. Nationally, it was 71%. So what is going on here? State Farm is doing better in California than they are nationally, yet California is the place that they're targeting for pulling out. And that is because the insurance industry's biggest target here is rate regulation. The voter-approved ballot measure, Proposition 103, that was passed in 1988. And if you could flip to the next slide.
After that slide, I'm going to interrupt you because we have Commissioner Sidley who wants to speak to you.
Great. This is just a little flash in the past. In 1986, the Little Hoover Commission, some of you may know, did a study on an insurance access and affordability crisis. And at the time called out the serious failures in insurance oversight in the state of California. And a few years after that, voters passed Proposition 103 to address a lot of those failures.
Commissioner Sidley.
So here's the disconnect for me, and I think you can answer it for me, but the insurance companies, clearly they're in the business of making some money, and I understand that. And you're suggesting they're making money. And what is confusing to me is if you're making money, why are you pulling out? And they are pulling out. And I find it a little bit hard to get my head around that they're pulling out just because there's oversight. So that leads me to the question of what else is there? I mean, it seems to me that maybe the numbers aren't quite correct, or that you're looking at a national model or something of that nature, because what you've just shown me is to suggest they're doing great here. Well, if I'm doing great as a business, I'm not pulling out, and yet they are. So I'm a little confused.
Well, there are several things going on. One is the real increase in costs that are happening everywhere. And it's, as Commissioner Jones said, this is not really a California unique situation. We are seeing inflation and increase in building costs and labor costs, and the real increase in the number of weather-related catastrophe losses. And so all of those things are real. What insurance companies are doing in California is like a ratcheted up version of what they're doing across the country, where they are restricting sales, making it harder for people to get insurance, canceling people who, like you, don't think they have anything to do with a catastrophe loss. That's happening across the country. But California is getting the spotlight. California is getting held over the barrel because insurance companies see the opportunity to get rid of this oversight in California that they have targeted since it was enacted in 1988. And you'll see from the plan that they have urged the insurance commissioner to put in place, which does, one of my slides basically mirrors what the commissioner put up. It is everything that they've already tried and has not worked in Florida. That are deregulatory solutions. And what we really want to bring to the table is the insurance industry is looking for ways to cut corners, drop people who are not the most profitable, which is what the insurance industry always does when costs go up, whether or not we are seeing the particular increases that we're seeing today from climate change. And so, yes, those costs are real. Absolutely, no one denies that. But there's more going on in the California marketplace. And this is the industry's 30+ year long campaign to find a way to get rid of this law. And they're really seeing the leverage point now.
Yeah, I get Commissioner Canella followed by Commissioner Johnson.
Yes, thank you so much for being here. So along the lines of the Commissioner Sidley, so you mentioned all these things that are happening, wildfires, inflation, expensive, things are getting more expensive. Do you believe that the insurance company should be able to increase rates to capture those increases?
Yes, and this might be my next slide.
Well, before we go to your slide though, so you do think, you
And they
believe
are
that?
getting rate increases.
And so when I read the different reports, it seems like the two sides are very adversarial to each other, which that's fine if that's the model, but it hurts all of us when that's the case. If you just said, look, there should be increases because of these things. And it'd be nice if you could sit down with the other side and say, look, let's all agree on what's happening and let's increase rates, because it just seems like there's such a fight back and forth that it takes a long time. So I hope that we can all step aside from our respective roles and kind of figure it out, because, people are losing their insurance, number one. Number two, you said the insurance company is forcing the insurance commissioner to do this. I know the insurance commissioner, and I can assure you nobody's forcing him to do anything. So that's.
If I said forcing, I
Yeah.
will take that back.
Okay,
They're not
thank you.
forcing. That's what they urged the commissioner to do.
That's
And he
fine,
is
but that's much different than forcing, and the Ricardo Lara is somebody that is not forced. So thank you.
I appreciate that. And I just want to clarify, because I think what you were what you were referring to there was the rate regulation process, when you were saying there are two sides that are adversaries. And Consumer Watchdog is one of the primary organizations, although we are not the only one, that participates in Prop 103's public review process. And that process is not always adversarial. The Department of Insurance has a job, which under Prop 103, this is actually the next slide, if you can move to it, which is requires companies to open up their books, to justify their rates, to get approval from the insurance commissioner before those rate increases go into effect. It requires full transparency of everything that goes into an insurance price. And it allows for this public participation process. So members of the public can also say, open up the books, hire an actuary, an attorney to look at the numbers and say, this rate increase looks excessive. I would also like to challenge it. So then there is a three-party process if there's a public challenger. And those parties are not necessarily adversarial. What they're doing is they're all crunching the numbers and then coming together in a conversation to say, this is what we think the numbers should be. We think your trends, you're overstating your potential losses in this area, but here we think you're right. And that process comes to an ultimate agreement. I didn't include it in here because I didn't want to get too into the weeds, but one of the things that the industry targets about this rate oversight process is the idea that they can't get rate increases fast enough. This is what they say, that this adversarial process prevents them from quickly responding to changes in the market. And the Department of Insurance has confirmed what the primary reason for that is, which is the insurance companies not providing all of the data they need to on the front side to prove that the rate that they're asking for is fair. And so one of the things that the department is doing that we are supportive of is proposing a new regulation that would require insurance companies to file a complete rate application at the start of the process. So then we only have to ask questions about the details. There might be some additional information we need, but it's all there up front. So the Department of Insurance isn't spending months going back and forth with the company saying, we also need this, we also need this, we also need this. That's a piece of the puzzle that we totally agree could be fixed, but it's not a function of allowing oversight or public participation. It's a function of the insurance companies providing what they need to show the prices are fair.
Thank you. Commissioner Johnson, I think, has questions.
Yeah, Ms. Balber, in your opinion, is the insurance company's threat to pull out of the California market, is that a disingenuous negotiating tactic, or is it a legitimate threat that they may actually pull out of the market that they are supposedly very profitable in?
I don't believe they'll walk. I do believe they will continue ratcheting up the pressure like State Farm just did and targeting more areas for non-renewal or restrictions on where they sell. And I think that's why, I'll jump right to my solutions. I think that's why we need to call their bluff. One of the biggest problems we have is simply the fact that climate change is marching apace. But as Commissioner Jones pointed out, we also have ways to reduce risk. And the forest management is one of them. And the other one is individual and community mitigation of fire risk. The National Association of Insurance Commissioners did a study that said a home's risk of burning down is 75% less likely if they do structural modifications and they do ongoing brush clearance, the defensible space around your home. And these things are proven to reduce the risk, which does in fact make California more insurable, yet that is not being reflected in anybody's insurance rate today. And that's something that really needs to be done, number one. Number two, we think we need a mandate that insurance companies do in fact have to underwrite those people who do the right thing and harden their homes, or are in a place where they are not facing those catastrophic risks. Yes, there are uninsurable homes, but we do need the legislature to step in and say, the insurance industry can't decide who can afford to or where Californians can live. That needs to be a public policy decision. And one of the decision points needs to be whether or not Californians have done what they can to protect their homes from burning down in a fire.
So to add to that, then, would you actually suggest then if an insurance provider was unwilling to insure in a particular portion of the state, that we should consider not allowing them to provide insurance in the state at all?
Yes.
Wow. Okay.
Yes, we think that in the state, so there's a few precedents for this. California, when the voters passed Prop 103, they put in place a mandate that auto insurance companies have to sell to every good driver. So we have a mandate that good drivers get insurance, not, folks with bad records or drunk driving, similar to people who build a home on the top of a mountain and won't protect it. Okay, I'm not saying you've got to insure that very bad risk, but people who do the right thing and are insurable should have access to coverage. And the stick to make sure they follow through is insurance companies should lose the privilege of selling here, not just home, but auto insurance, if they refuse to sell to the people who are least risky.
So I'm going to follow up if you're done on, you said call their bluff. And now you're talking about maybe setting up a situation where insurance companies shouldn't be able to write insurance in California. That's a nice tactic, maybe, if it didn't mean for so many family homes that they can't carry a mortgage. I don't know how long we have to wait to call the bluff, because people are suffering right now. You cannot carry a mortgage if you don't have insurance. So I'm a little concerned with call the bluff, because this is today. This is people who cannot live in their home today. So I'm a little bit concerned, like, how long are you willing to wait to call the bluff? How long are you, when would you make this decision that people can't write in California to make insurance completely unavailable or so expensive that people are out of their homes anyway? So I'm just, maybe you didn't use the right word or the right words, but calling their bluff is to me catastrophic. And so I'd like to hear more about what you're really saying, because telling insurance companies you can't write if you're not willing to write in the middle of a forest, what does everyone else do?
If you're not willing to write to those homes that are safest, and that is the key. And when I say we should call their bluff, and I do think we need to act immediately, this is a change we need to put in place now while the insurance industry is still making money, before we reach a point where it's no longer sustainable. If we call their bluff, the insurance industry is not going to leave the largest insurance market in the country when they are not, in fact, bleeding money right now. They will work within the system to insure the people who are least likely to lose their homes. In the meantime, we then need to figure out a strategy for drastically increasing our investments in home hardening and mitigation, which some people can afford to do, but many cannot, because that is what's going to continue bringing the risk down in the state. And the other piece of the puzzle is that the insurance industry is concerned about their liability at the FAIR Plan. And the only way we can ensure we start pulling people out of the FAIR Plan is by making insurers cover people who are actually least risky. Those homes will then be pulled out of the FAIR Plan. Insurers' liability in the FAIR Plan will be reduced, and they will have less liability on that side that they're concerned about. So I do think that mandate, which isn't going to mean that insurance companies are covering every home in the WUI or in the forest immediately, will get Californians insured right away. And we will not see the insurance industry leaving California.
I hope that you're right. I don't know. I think what you've suggested is a lot of litigation over what it means to be safely insured, and a lot more issues as to what houses are good insurance or available. So and I'm looking at, taking myself out of the equation. I'll deal with my situation. It's fine. I think there's a real crisis here in California, and I think it is hitting people in the pocketbook. And, I, for one, think, sadly, it may be better to pay a little bit more than have nothing. Because if I can't carry a mortgage, I really have a problem. And California will really have a problem if people can't carry mortgages. So I just not sure that calling someone's bluff, what if we're wrong? So I'm skeptical of that, candidly.
Commissioner Cannella, followed by Commissioner Byer.
Yeah, I have a question on how things work. So I'm not an insurance expert. I just pay my insurance every year. But so you mentioned, you brought up auto, right? So if you're a good driver, then you have to be insured in some mechanism. And I think that's applies over to the housing as well, per what you'd like to see. But in driving, if I have 10 speeding tickets, my insurance is going to be really high because I'm a higher risk. Do you think it should be if I live in a high risk area, I should pay substantially more? And does that happen today?
I think you should. It does happen today. But what also happens today is we have no idea how those decisions are actually made. Because even though Prop 103 requires full transparency of what goes into a rate, as Commissioner Jones said, the models that insurance companies are using for underwriting are completely opaque. We have no idea how they're making the decision about whether or not your home in particular versus your neighbors down the street is at higher risk of a fire or some other sort of natural disaster. And that is because the companies who make these models, largely Wall Street firms, claim that it's their intellectual property and they cannot share what they're doing inside that black box. And so because of that, insurance companies are definitely setting huge rate differentials. So the person in the fire area, if they get insurance, is paying 500 times what the person in the middle of the city is paying. But we have no idea, no way to test right now how they're making those decisions and how they're spreading that risk.
Okay. So today, if you live I think we can all agree there's certain areas that are higher risk if you live on a fault or you live in a forest with dead trees, right? We can kind of have some common sense versus, if I pay twice that my neighbor, then that doesn't make any sense. But today, the insurance company does have the ability to charge higher rates for somebody in an area that's, higher prone to natural disaster. Okay. All right. Thank you.
Commissioner Byer.
Thank you for your testimony. Maybe staff could help after the hearing. It seems like there's a legal dispute between yourself and Commissioner Jones, at least if I understood his testimony. He indicated that homeowners had access to information about the methodology used in underwriting.
Well,
is that not true?
It's sort of true. He's not wrong. The Department of Insurance.
So you're right and he's wrong?
No, we're both right. It's because there's a law that isn't being enforced right now.
Okay,
so,
but okay, sorry.
So consumers do not have access, but they're supposed to have access.
And their rights are protected by the Department of Insurance, and the Department of Insurance doesn't enforce the rules?
So they're not yet. I can explain if you'd like me to. So first off, there was a regulation that was developed by the Department of Insurance and the Emergency Management Department, et cetera, that set outline for what they call Safer from Wildfire guidelines, which are state-approved guidelines for what you should do to protect your home from fires. So there's like 10 individual guidelines, 10 or 11, about replacing your roof and covering eaves, et cetera. And then there are also 2 measures of community preparedness that outlines for these are the things you can do to protect your home. The Department of Insurance then had a 2-year-long rulemaking process where at the end of it, they approved a regulation that said a couple of things. One, that every insurance company must offer a mitigation discount to consumers who meet any of these guidelines or live in a protected community. 2, they have to disclose to consumers what the rate impact is to them of each of those, of taking each of those steps, and also what their wildfire score is. Those regulations, although they took effect, and the FAIR Plan has implemented them, no other insurance company in the state has yet had their mitigation filing approved. And that means that a consumer who goes to their insurance company and says, what is my score and how might I change it? Or how much could I save based on these mitigation steps, isn't getting that information today. So the regulation was approved, but insurance companies had to file how they would implement it, and the department has not approved any of those filings.
And is that a question of delay between this filing and today? I mean, we've got a representative of the insurance industry coming up, and we'll ask that question. But it seems like you're calling for something that already exists, and your quibble or your dispute is around whether the Department of Insurance is enforcing their own regulation.
One thing already exists, which is the discount for mitigation, but that regulation did not address whether or not insurance companies have to sell to people who home harden.
So
And that's the
are you
addition.
arguing that if you're in a mitigated area, that's per se safe and should be automatically insurable?
I'm sorry.
In other words, if you've got an area in Los Angeles that's done all the hardening and done all the community mitigation, all of the homes in that area, should they automatically be insured? And is that something, isn't that a underwriting question as opposed to a rate setting question?
It is.
And isn't that better decided in the private sector with some degree of transparency?
No, we believe that Californians have paid into their home insurance premiums for decades. As a state, we told people they could live there. The risk has changed. We recognize that. And that means costs are going up, and insurance companies should be allowed to reflect that. But we cannot allow the insurance industry to declare entire swaths of California unlivable and tell those
I'm going on the other side of the equation, which is something that's safe.
Yes.
Because you've already got all the mitigation. Is it feasible just to say those homes are insurable?
Yes, I think it is and should be done. And that has to be passed through the legislature.
Okay, thank you.
Yes.
Yeah, hi. I have anybody else before I ask a question? So the issue of underwriting has been described as a black box, and there's been a call for the legislature to open the box through their processes, right? To write legislation that requires the insurance companies to disclose. They say it's intellectual property, but there are ways to protect intellectual property so that they're not disclosed at large, so it causes harm to an industry. But are you aware of any other states that we as the commission could look to as models that have legislation that opens the black box of underwriting?
Two things. There are, I believe, and I'm looking into this, there's a model, I think, at the Department of Energy where the climate models that are used, economic climate models, are accessible. And I'm kind of just still looking into that now. Most states don't have the kinds of transparency requirements that California does. And frankly, companies should be disclosing a lot more under the law even than they do today. There have been efforts by a number of states to start better regulating how these models are reviewed. For example, Colorado is in the middle of a process where they are setting out guidelines for determining whether or not a model contains bias. So there are different areas. We really believe, and this is at our solutions at the end, but that the way to ensure climate modeling is accurate, using the right science, fair, unbiased, and make it fully transparent is for California to invest in the creation of a public model. We have the best academics, tech, everything as far as it goes to climate science in California. And to ensure that Californians are being treated fairly and that we're using the best information possible, we think that California needs to build a model for itself. So we can use that not only to be sure that the way we're factoring climate risk into insurance rates is fair, but also so consumers have full access to what their own risk is, what they can do to mitigate that risk, and frankly, so the state has access to that information for all of the other decisions that we need to make that are climate related. And so much of that information is kind of compartmentalized. You know, the Department of Fire has some things, and a climate model would make that more accessible for every level of government, not just the insurance industry.
Okay, so as I explained, it's common for commissioners to interrupt people making presentations.
Totally fine.
And I apologize for that. It doesn't seem to have caused you any harm.
I prefer it, actually.
You know what? If you'd like, we can get back to, I believe you have some other.
I think there were a couple points that we
Okay.
got to along the
Please
way
do.
that are in the presentation that are worth pointing out. Maybe we're like 4 or 5 slides in.
While you're doing that, have you suggested California creating its own model to the insurance commissioner? And what happened with that?
So the insurance commissioner, I mean, the ironic thing about State Farm's announcement last week, or suspicious thing in my book, is that they made this announcement last week at the same time that the commissioner released the first draft of his catastrophe modeling regulation, which is exactly what the insurance industry is saying that they need. And at exactly the same time that State Farm got a $500 million rate increase that took effect this month. But on that specific point on the models, so the department introduced the regulation last week. We think it has serious transparency problems. It would not allow the public to adequately gauge whether a model is fair or accurate, and would keep most of those decisions still hidden. We have urged the Department of Insurance to, rather than go this private modeling route, to support the creation of a public model. They have, that request has largely fallen on deaf ears, although they do, mention a public model as an option every time they raise this issue, and then they just continue down the private model path. So. Someone is asking about rate increases. I just want to make clear that home insurers are in fact getting rate increases in California. They've gotten 92% of the premium increases over the last 3 years that they've asked for. Most of those were at the full amount they asked for. Some of them were reduced because the Department of Insurance or interveners like us felt that they didn't need as much of an increase as they wanted. The average increase was 13%, but they went up as high as 65%. And so insurance companies are getting to factor in these legitimate cost increases into their rates. And you can go forward. We can skip this one and the next one because they just repeat what Commissioner Jones said, which is all of these solutions that the industry is pushing in California, and that the commissioner has largely announced he's going to do in his sustainable insurance strategy, have failed to fix the market in Florida. Insurers are leaving there. Their rates are 2.5, 3 times as high as California's, and 5 times as many people are in their FAIR plan. So all of the solutions the industry is pushing is not stabilizing the market, which is why we think we need the solution that is a mandate to cover the people who are not risky. I just want to also clarify something about the commissioner's plan, which is out there and he's never directly addressed. In return for all of these reforms, deregulation, we would call it, that the insurance industry wants, the consumer benefit in the insurance commissioner's deal was a promise by the insurance companies that they would go back into the riskier wildfire areas, that they would sell 85% of their market share in the rest of the state in the risky areas again. But We have never seen an insurance CEO come forward and testify that they have in fact made that commitment. And we did a Public Records Act request to the Department of Insurance and obtained the text of the legislation that he had negotiated with the insurance industry at the end of the legislative session last year. All of the points from his sustainable insurance strategy were in that bill, including this 85% commitment. And the language of the bill says that insurance companies could meet their commitment not by selling a standard comprehensive home insurance policy, but by selling a bare bones fair plan equivalent, which would mean consumers who, under the public presentation of this deal might think that they're getting access to home insurance again, would in fact be stuck in exactly the same position they're in today, which is they have access to the fair plan. Now they just be buying a fair plan policy from State Farm. And so if that is the case, then consumers will have literally gotten nothing from what the Department of Insurance is proposing. And we will be in a situation again where we're trying to find a solution to getting people access to coverage. So I just want to, and we've asked the insurance committees of both houses of the legislature to grill the department on this, and they have yet to ask the commissioner that question. So if you get him here, it would be amazing if you could ask him if that's really what this 85% commitment means. And the last slide is just our solutions, and I think we talked about most of them, but I think maybe the only one we didn't touch on is the need to be smarter about where we're building. So if we do impose a mandate that you have to cover people who are safe, that doesn't encourage, more building in risky areas that no matter what you do, it's not going to be a safe location. So I think maybe the last piece of that is just really needing to do serious investment in mitigation, because we can't just insure our way out of this. We need to reduce the risk in California, and the state is very focused on reducing the risk of climate change, but in the short term, we need to reduce the individual risk, and that is investments in mitigation, not just by the state, but we think the insurance industry has to have a hand in that. And one thing Commissioner Jones pointed out was that the insurance industry is contributing to the fossil fuel crisis by both investing in and underwriting fossil fuel companies. There's a proposal in Connecticut that is being talked about right now that would tax companies that invest in or underwrite fossil fuel companies and use that money to help subsidize mitigation. And I think that's a great idea. But with that, I'll.
Commissioner Garcetti.
Thank you, Ms. Balber, for really making some very key points, important points. I want to emphasize my own view that this is not just important, obviously vitally important to homeowners, but to landlords and renters alike. So it's a very difficult subject and a scary subject, especially when I read and learned about what happened in Florida. So I have two questions. One, do you think that we're sliding toward the Florida model? That is, that we're going to be losing more of the major insurers? And are we ever going to be at the point where we don't have sufficient number of insurers that there has to be an alternative? One alternative that I would highly question, but nevertheless, the model would be when Los Angeles took over the water district, and it was a bureaucracy, and it is a bureaucracy there. Do you ever see that, foreseeing that as an alternative to what is happening here today with insurance companies?
The public taking over is what happened in the earthquake market, actually. When Northridge hit, the insurance company said, we can never sell earthquake
Yes.
again. You're very well aware of that. And the California Earthquake Authority is a failed model. Nobody buys it because it's way too expensive.
Yes.
And in the meantime, the Northridge earthquake every year that the insurance industry's models claimed was going to happen never actually came to fruition. So I think we need to develop a solution that works within the insurance industry as we know it. Are there pockets where the public can and might need to step in? Perhaps. Senator Schiff has legislation at the federal level that would create a federal reinsurance authority that would require insurance companies to cover all perils, but in return would give them access to a level of federally backed reinsurance for the worst catastrophes. And that kind of, worst case scenario, climate disaster might be a place where I think there is a role for the government to step in. But I think we need to figure out how to manage the insurance industry that we have, not try and replace it with a public alternative. Yeah.
You made the comment of Senator Schiff. What state does he represent?
Oh, I'm sorry. That was a Freudian slip. Thank you very much.
Sure.
Yeah, I don't see, yes, Commissioner Arner.
There we go. Thank you. Good morning. I've been learning a lot, but but there's one area that Commissioner Jones mentioned, and you've kind of alluded to, but we really haven't talked about a lot, and that is the siting of homes, right? In areas where they shouldn't be sited. I think about the Russian River on a regular basis, right? That floods and somebody steps in, I guess, and they rebuild, and then it floods again and they rebuild again and then go back and forth. And there are, I think, 5,000 cities in California who make planning decisions on a regular basis with very little standardization, right? You can go from one city to the next, right next door to each other, and they have different ideas about what should be built and where it should be built. What do you see? I'd be interested in your comments about what do we do about that? Because it's part of the problem, and the question is how what would we do to go about figuring out some standardization, some rules at the state level, whatever you want to call them, to say, wait a minute, we can't keep doing that, right? Because I'm an insurance company, I wouldn't blame them saying, wait a minute, I don't want to do this again, right? It's right, repetition like that doesn't solve anything.
So I am definitely not a real estate or building expert, but I completely agree. And it is definitely what we believe is a piece of the solution, that we need to start making some development decisions at the state level, whether it's through a building commission or some other mechanism, in order to not have these locality by locality fights over whether or not it's safe to build somewhere. And I think it was Chico that recently had a ballot measure that a developer had moved forward and the city had moved forward, and the public challenged the development and won at the ball to prevent a development in an area that had burned twice in the last dozen years or something. But and the AG's office has lawsuits against different places. Localities have, it's being fought out in the courts instead of in a more measured way. And so I don't really feel like I'm qualified to say exactly how we need to do that, but we definitely agree that that needs to be more coordinated at the statewide level.
Yep, it looks as though all the commissioners, I do have one last question. I don't know if you've put together the information or if somebody else has. Do we have some idea of what the total premiums paid by homeowners to all of the carriers are for California?
That is one of the few data points we do have. That is reported to the Department of Insurance every year. So that I should have it at my fingertips, but I don't. There is a lot of information we should be collecting and aren't. I could not tell you, for example, which insurance companies sell in a particular zip code, which zip code might have only access to the FAIR plan, where mitigation has happened and where it hasn't. That kind of data collection, when I was thinking about things that could be really useful for the Little Hoover Commission to do, I really think there's a lot of data on that front that we're missing. The Department of Insurance could be asking for, or on the mitigation front, because they don't really have that information. The commission could be asking, could begin to try and collect from the local entities and regional entities that collect it.
The reason why I asked that, and then I'll go to Commissioner Byer, is it sort of dovetails with what Commissioner Garcetti was asking. And it was one of the questions that I posed to staff, which was, if the problem is of such magnitude that there shouldn't be some consideration given to a California insurance authority. You've indicated that perhaps in some limited circumstances with respect to specific disasters or a certain set of boundaries that might be appropriate. And I think it would be helpful for the commission if we knew if it were like $2 trillion in premiums that are paid by California homeowners, because then that raises the issue of, where does that resource come from? But let me turn to Commissioner Byer.
Just a point of historical interest for newer commissioners. We, Little Hoover, did a report on geospatial information, which the governor very much supported. So the idea that the insurance department would actually collect information of the type you're describing is something consistent with what we've said in the past, but we would very much welcome additional suggestions from you and the industry about things that could be useful, not for academic research, but for guiding policy making. I mean, right now, as I understand it, we don't know a lot about the decision to renew or not renew based on either geography or rationale or economics or diversity and equity considerations. There are a whole bunch of data that would be highly useful to guide the public conversation. So we welcome some more data.
Great. Let me offer thanks for your testimony, and let me turn to Tamar for our next witness.
Thank you. And our next witness will be appearing virtually. This is Amy Bach. Amy is the Executive Director of United Policyholders, which is a nonprofit advocacy organization she co-founded in 1991 to represent all types of insurance consumers across the country. She also serves on the Federal Advisory Committee on Insurance and the Fire Victim Trust Oversight Committee. Welcome, Amy. Thank you for joining us.
Thank you so much. Let me get my video on here. There we go. It's not letting me. There we go. Nope. Okay. It's my pleasure to be here with you. I appreciate the commissioner's time. This has been a fascinating conversation. My organization did submit written testimony, and my slides are very, very abbreviated version. So if we can go to the first one. Or the second one. Thank you. So my organization has been in business since 1991 as an insurance consumer education and advocacy 501c3 nonprofit. We focus on fair insurance practices, disaster preparedness, and recovery. That's our website. We get over 500,000 visitors a year on our site. We are based in the Bay Area, but we do have a national reach. We run 3 programs: Roadmap to Preparedness, Roadmap to Recovery, and Advocacy in Action. We provide for the public trustworthy, plain language, consumer-oriented guidance on insurance matters. We're very involved in disaster preparedness and recovery. We have been closely monitoring the property insurance marketplace here in California since this crisis started to develop. We've been coordinating with stakeholders to restore affordable options and working very hard to help people reduce risk and keep their property adequately insured as this crisis has continued to deepen. So a lot of the guidance that we were giving consumers when the tree mortality crisis first manifested and started to result in non-renewals in the foothills communities, we've had to continue to update because the market has been changing very fast. And if you talk to anybody, insurance agents, pretty much anyone in the ecosystem in California, they'll tell you, they'll use the word unprecedented, that no one has ever seen conditions like this before. And I think, very interesting dialogue between you and the former commissioner, and then you and Carmen. And it'll be, I hope to give you similar insights, and then you'll be hearing from an industry representative. So, and I think a number of other stakeholders as the hearing goes on. But I think you're not going to find someone much more steeped in this from the consumer side than myself, because not only have I been building out programming here in California to try to help consumers navigate, but I am a funded consumer representative at the National Association of Insurance Commissioners. So I am working with insurance commissioners from all over the country that are having similar problems, listening to the presentations that carriers are making there, keeping my ear to the ground with the reinsurance industry. And I'm also on this Federal Advisory Committee on Insurance to the Treasury. Some of you may know that after the 2008 meltdown, there was sort of a general recognition that state-based insurance regulation wasn't quite enough to prevent what we had happen at that time, and the government having to bail out AIG. And so this federal insurance office was set up through Dodd-Frank with limited resources, and there continues to be some tension between state regulators and the federal government as to related to oversight of the insurance industry. And the Congressman Schiff bill that that Carmen mentioned is one of a number of initiatives that actually we discussed last week at a federal advisory committee meeting in the Treasury building that I was at. And it's clear that that bill is not going anywhere right now, and it's a very, very big moonshot, but that it's got a really important piece to it that I think is part of the solution that we all are looking for here. Next slide, please. So the bottom line, as you all know, that's why we're here, that we're in the grip of a crisis, and in many zip codes across the state, non-renewals are a plague. Name brand insurers have stopped selling new policies or imposed very strict limits on the agents that are authorized to sell their products. 5 a month is sort of a common one I've heard. Premiums have doubled, tripled, and worse. Some of you may have read the story or heard about. There's a community called Brisbane, which is right near San Francisco's airport. And because it's close to an open space area, their residents are experiencing some of the sharpest edge of what's going on. And condominium association there has made public the fact that their insurance premium went up 1,000%. And they are with what's called a non-admitted company. And one of the things, a surplus lines company, and one of the things that's happening, like it or not, is that a lot of California properties, both commercial and residential, are, if they're not going to the FAIR plan, they're now moving into these surplus lines companies, which we're going to talk about. Well, and that is a problem for all of us for a couple of reasons. One is that surplus lines insurers don't participate in the California Insurance Guarantee Association, which is the insolvency backstop that when Merced Casualty found itself after the Camp Fire in Paradise unable to pay the claims of the homes that had insured in that community, those homeowners were able to get $500,000 apiece from the Insurance Guarantee Association, and that's an example of how SIGA works and is important. Surplus line, these companies that more and more Californians are migrating to because of the exit from the market by a lot of the brand name admitted insurers, means a lot of our households are more vulnerable than they had been. And I meant to start my comment with really thanking Commissioner Garcetti for those opening remarks, because I think that this situation that we're in some days it really overwhelms me, and I think it overwhelms a lot of people. And I think the commissioner and his team have a brutally hard job right now. And so I try to give them as much grace. And I think also that, recognizing that we've got a really complicated problem here is important, because one of the things, and Commissioner Garcetti was talking about the beauty of nature and the amazing aspects of nature. And one of the things that's making it hardest for us to get wildfire risk reduction at the individual parcel level and the community level, which is what we all want to see and we need, and insurers are really insisting that it's not enough for one house to do it. It's got to be, you got to have critical mass, is that it requires people to take away trees that they really love. And that is one of the brutal realities of this crisis. It's one of the many brutal realities, which is that people love their trees. We love trees. They give us shade. They're beautiful. And part of what has to happen is people have to take them down if they're close to their homes. It's a big deal. Anyway, so thank you for that. I try to keep some positivity. I spoke to a law school class last week about this situation and said, people are saying we're the first generation to feel the impact of climate change, and we're going to be the last generation to be able to do something about it. But when we see complicated problems, we have always been able to tackle them as a society, and we're going to hopefully keep moving forward here with this particular one that we're here to talk about. So back to my slides. Not only do these surplus lines insurers not pay into this bankruptcy insolvency protection fund, but they also don't have to participate in the FAIR plan. So our FAIR plan is overwhelmed and problematic. You won't hear people saying good things about it very often, but I'm going to say one thing about it that's very good and that distinguishes it from Florida's version, Florida Citizens, which Louisiana copied. Theirs is identical to the Florida program, and Colorado, the FAIR plan that Colorado is just building. It's going to be online probably next January. They'll be selling products. Unlike those, ours is really, it really is the private insurers that backstop that program, not taxpayers and not policyholders at large, right? So it's a unique recipe. We built it in 1968. I don't know if we could build it today. So I always feel when I'm speaking to public officials, I want to remind everybody that the core recipe is a good one, in that it's an involuntary association of private companies, and it's their capital that is paying. Well, obviously it's premiums that policyholders pay, but then the companies that participate are the ones investing those premiums, making them grow, and that's really how the system works. And when they have claim paying obligations, it is their participating insurers that meet those, that pay those claims. It's not going to be taxpayers. That's a really important part of the FAIR plan. But it's also part of the reason, that a lot of the admitted insurers are shrinking, because the bigger their market share in California, the bigger their share of potential liability for FAIR plan claims paying is. So it's really important to understand that dynamic. But again, the companies that are picking up a lot of homes right now don't have to pay into the FAIR plan. But as you'll hear as we go through your considerations, some of the great ideas, like the one that we talked earlier about, that an insurer must offer a policy to a home that is mitigated, is a very, very hard sell in the legislature today, because the market conditions are so bad that we are looking for things to bring insurers back. And believe me, I've been a consumer advocate, insurance consumer advocate my whole career. When I hear regulators say, and I heard many state regulators saying this at the conference that I was at just 3 weeks ago, that they are begging insurance companies to stay in their states, that kills me, because I can't stand that kind of power imbalance. But that is the reality. We have a private market. We don't have a model, other than some of the municipal risk pools that I will mention later. We don't have an alternative. So, this idea of meaning an alternative place for California property owners to have the financial protection that we want them to have for adversity, and that their mortgage companies require them to have. So we don't have a plan B. So playing chicken, I don't really see that as an option, because while I don't like to see insurers having this kind of economic power, it is what it is, right? If in fact, I do agree with Carmen, with Consumer Watchdog, that insurers have been trying to undo Prop 103 since it was enacted, and their pitch for deregulation is as consumer advocates, we don't support that. But the reality is, they're all we have right now. And our FAIR plan is based on the private market being here. So we have to be really thoughtful about the way we are moving forward here. I think, again, great points about, that insurers got a whole bunch of money from PG&E, in connection with the Camp Fire and some other fires, that should offset their underwriting losses, and they've never lived on underwriting alone. So when they say, when insurers will say, for every dollar, we took in premiums, we paid out, $1.10 or what have you, that just ignores the reality that they don't live on premiums alone. They never have. And that it's the investment income, that they earn and on the float and on the premiums that really generally has kept them profitable. So we have to take all these things with a grain of salt. So number 4, you all know this probably. If you have not gotten non-renewed yourself, you must have neighbors and friends who've been non-renewed and are scrambling. And for people trying to get into the FAIR plan, they did switch over to a different tech platform in the fall, and it's been a bit of a cluster. They're moving through it, and agencies are getting creative at calling first thing in the morning and sitting on hold, but it is taking them weeks to bind policies. And there are a lot of people whose properties are having coverage gaps, which of course is not a good thing. But it's there. It's a critical safety valve. Our guidance at UP, which we are putting out all over the state. I have a whole team. We are speaking to community groups. We are working in tandem with the Department of Insurance. They're doing the same thing. We're going out and explaining to people what their options are and what you can buy through the FAIR plan and all that. But at this point, desperate times calling for desperate measures. We are really encouraging people to try to keep their focus on at least insuring their home. And if they have to cut coverage, cut it for contents, cut it for their garages and outbuildings, but try to keep your home insured. And that's kind of a continued focus for us. The Commissioner's Sustainable Insurance Strategy is focused on regulatory reforms. My organization has not done intervening except for basically once when we started seeing the risk scoring phenomenon, where suddenly, which is now a huge deal, right? When insurers started using Fireline and Bear Risk and CoreLogic to slap a number on a house, like they give you a credit score. And that number had just started to when we were first looking at this, as this crisis was developing, we thought, maybe it's the scoring. Is that what's going? Is it the scoring? It's definitely part of the problem. So we did intervene to try to bring more transparency, and the department did respond, and they have, as you heard, they do have a regulation in place that your insurer, if they non-renew you, they have to tell you what your score is, and they have to give you an appeal process. Some of the agents we work with have been successful, and we teach consumers how to push back. Maybe your score is based on incorrect information about where you're located or how close you are to a fire department or a fire hydrant. Those kind of things we are helping consumers try to improve their scores, but the genie's out of the bottle. I mean, the insurers are way down the road now at using risk scoring systems. So I don't know that we're going to be able to bring that back. But the regulatory reforms, you're going to hear more about. I'm sorry the department isn't here. I do believe their team is working incredibly hard to try to thread a way through this. And I think, with the CAT models, they dropped that reg a couple weeks ago that, those were the 2 top things on insurance companies' wish lists, where we want to be able to use catastrophe models, and we want to be able to pass along reinsurance rates, our reinsurance costs into our rates. Those have always been 2 of their priority items, but their other priority item is shortening the time to get their rate approvals, and I've heard this everywhere I go around the country. Oh, in Nevada, we can get our rates approved within 3 weeks, or in many states, they don't have to wait at all. They're file and use. They file them, they use them. Those states are having affordability problems too. So I think, some balance is very important here. I think that, I look all the time at, does the California Department's Rate Reg Bureau have enough people power? Do they have enough staff? Are they with remote working, they did slow down. Consumer Watchdog is, performs a very important function, but we need the department on its own 2 feet to be able to have the tools, the staff, and the transparency to be able to intelligently parse those rate increase applications, because we do want them protecting our consumers. They've been doing it. It's just very controversial now because the insurers have said over and over, we've lost hope in California that we're going to be able to collect the rates that we need in this era where inflation and climate change is really making a dent in our financial health. And you will hear from Rex that there have been some ratings downgrades by some ratings agencies. So it's not just a matter of that the insurers are playing political game here in California to try to deregulate. I do think they are, but that is not the whole story by any means. And I think the CAT modeling piece, I've kind of made peace with it. It was extremely frustrating to have the commissioner drop the reg, give the insurers one of the #1 items on their wish list, and then the following week have State Farm make that announcement. That was a real, that really threw us. I think it also threw the department. I think they did not see it coming. Very frustrating. Next slide, please. But the question about State Farm is really, where does the truth lie, right? They have posted a big underwriting loss 2 years in a row. As I said, though, they don't live on underwriting income alone. So, they will say, well, we wouldn't have done that. We all have been saying from the beginning, insurers are not going to leave California. It's a super lucrative market, right? But they are leaving. So it's tough. What are the underlying causes? I would say the #1, risk segmentation facilitated by technology, the risk scoring systems, the models, and the drone inspections. There has been such an explosion in the tools that are now available to insurance companies that magnify risk to a point where, as the judgment calls of their executives are, we're not going to make money here, right? That's kind of the root, I think, here. Inflation is a big deal. A hard reinsurance market is a big deal, because the reinsurance market holds all of us hostage. Prices have been very high. Capacity has been limited. The California Earthquake Authority, which you heard mentioned, which I don't consider a failed program. I think it's a challenged program, because partly because they have to spend so much money buying reinsurance that it makes it very hard for them to sell a product that people want, but also, well, whatever, we're not here to talk about that. But the point is, they hit a wall, the CEA hit a wall with their reinsurers where they couldn't buy any more reinsurance. They literally couldn't. And so what did they do? They reduced the amount of contents coverage you can buy, down from I think it was 200,000 or so to 25,000, something crazy like that, because they were desperate to try to balance their books with the high cost of reinsurance. So that's a big factor here. And insurer discontent with the regulatory process is not, you can't dismiss it. And then the elephant in the room that you heard lots of eloquent points from former Commissioner Jones, increasingly severe weather events associated with climate change are a fact here, and a factor that is really just leads to the question of who's going to bear the cost here, right? We talk about like all problems, it has to be spread, right? The pain has to be spread. That's what we're really here to figure out, how to spread the pain here, right? We talk about people coming to the risk that they should be, insurers have long said, and environmentalists have long said, insurance is a price signal that tells you how risky it is where you're living. Well, the problem is, we all know, is that we have hundreds of thousands of people in California who are living, who did not come to the risk. They just didn't know it was as risky because they've been living there a long time. And obviously all of us that are worrying are worrying the most about people on fixed incomes, senior citizens that are completely stuck between a rock and a hard place. And we don't want them going bare if they own their homes outright, and they don't have, and a lender isn't making them keep insurance in place. But we also don't want them to have to sell their homes. It's just a very, those are the folks we worry the most about, right? Next slide, please. So how my organization is helping, we keep very close to the ground, talking to agents and brokers, talking to
Yeah, Ms.
dealers.
Bach.
Yeah.
Yeah, I'm going to interrupt you because we have a
Sure.
commissioner who has a question.
Oh, please. I'd be happy to.
Thank you.
Well, thank you for your testimony and for what you do every day. Speaking for myself, I would like to hear from the industry. And so maybe if you could wrap up your testimony, that would permit us to get to hearing from the people you're expressing such sympathy for, that is the plight of the insurance companies.
Well, I'm sorry if I miscommunicated. I'm not concerned about the plight of the insurance companies. I'm concerned about the people that my organization is helping every day. I'm a pragmatist, and my organization has been very, very hard at work promoting mitigation, facilitating mitigation around the state, trying to get insurance companies to reward people who mitigate. So there must have been something I said that caused you to misunderstand. I'm just a realist and a pragmatist. I live in this world with the people that are getting slammed.
So if you, what happens with the presentations, and you've done a good job of outlining, the challenges that you face working with, let's call them your constituents. What recommendations are you suggesting that the commission should examine?
If you can, okay, if we can just
Sure.
go back to the slides, I just have a couple more.
All right, good, thank you.
So if you want to just jump to where we were. Keep going. Next. Next, please.
It's loading. It'll be just one moment.
I believe that we're trying to advance the slides, Ms. Bach.
Sure. Yeah, I can just riff real quick because
maybe you can just quickly go through your recommendations.
I appreciate that. My organization, with funding from the Governor's Office of Emergency Services, we have a resource center for homeowners on all the steps that they can take. We've been working very closely with we were part of the group that put the sustainable strategy, the Safer from Wildfires framework into place with the 6 things that you need to do to your home. So what we are working on right now is just continuing in community after community to teach people what to do, to identify the grants and the support, and to make it as easy as possible for people to reduce risk at their homes. So the 3 concepts that I want to leave you with, I do think Commissioner Jones's idea about letting the FAIR Plan issue cat bonds is a really interesting one. Publicly supported nonprofit insurance and reinsurance concepts are imperative. No matter what we do here in California, I am not sure that the admitted insurers that we are familiar with are going to come back in the way that they've been in the past. They certainly have not come back to Florida, and Florida has tried. They have a public cat model. They have a public reinsurance facility, and they still are having trouble keeping the brand names in. So that's just, again, a reality check for you. Risk pooling, I'm working with some of the municipal entities that when insurers abandoned them in the 90s, cities around the state got together, and now they have a very robust risk pool, and we have a working group looking at how we might do that, innovating with community-based captive entities, and then increasing support, incentives, and rewards for community-wide risk reduction. United Policyholders worked very hard to get the mitigation discounts in place for the households. And again, I don't know what I might have said that gave you the impression that I feel sorry for insurers. I don't feel sorry for them. they're business people and they make decisions like a business person. Do I wish that people's premiums had gotten them vesting all these years? Yes, I do. But we didn't have that. Do I wish the department had the ability to limit non-renewals even more than he already did? I wish he did. Now is a very difficult time to try to get the legislature to impose new restrictions on insurers at a time when they are making it very clear and very loud that they don't feel comfortable doing business here right now. So that's just a reality that I am here trying to help you get your arms around. So I think that's probably all I've got it. What's the next slide? And yeah, this is just look, I'm not championing cat models by any stretch. I think that every other state though allows them, and insurers are saying if you let us use cat models, it'll make it easier for us to give mitigation discounts. The reason the department hasn't approved anything other than the Fair Plan mitigation discount is that the carriers came in with very tiny discounts that they didn't feel were going to move the needle. So again, we want those discounts, but we want them to be more than 3%, 4%, 5%, because that kind of a discount is not going to make it financially viable for a household to spend money on the Safer from Wildfires or the IBHS Wildfire Prepared Home designation. So I really appreciate your time. I don't know how the regs are going to play out. I appreciate the work, and I remain available to your team. You can go to the next slide to help you continue this work.
Thank you very much. Let me turn to the commissioners to see if anyone has any questions. It doesn't look as though they do. I want to thank you, Ms. Bach, for your presentation and for the work that you do every day with folks that are confronted with what must be quite a bewildering set of circumstances. Thank you very much.
Thank you.
And I believe our next witness has been waiting patiently in the room. This is Mr. Rex Frazier, who I met many, many years ago when I had the pleasure of serving on the insurance committee in the legislature. And I guess let me turn it to Mar to give a better introduction.
I formally introduce him. Thank you for joining us today, Mr. Frazier. Rex Frazier serves as the president of the Personal Insurance Federation of California, where he represents some of the largest property and casualty insurers in the state. Previously, he was an attorney in Los Angeles, focusing on insurance and banking issues. And he also served as Deputy Insurance Commissioner with the California Department of Insurance, as well as legislative staff in the California State Assembly. Thank you again for joining us this morning.
Welcome.
Thank you. Chairman Nava, Vice Chairman Cannella, and members of the committee. My name's Rex Frazier. I'm president of the Personal Insurance Federation of California, an association of insurance companies representing the combined California homeowners insurance market share of 74%. Thank you for the opportunity to share our views on the California homeowners insurance market. And in these opening comments, I hope to address three issues. First, how did we get here? Second, what is the current state of the market? And third, what reform options are within the insurance commissioner's current powers? As for the first question, how do we get here? The issues of today are firmly rooted in decisions and indecision from many years before. The current insurance commissioner inherited the accumulated weight of at least the previous 10 years. While much has changed in California, California's insurance regulations continue to echo from the 1990s, a time of fax machines, a time of the mullet as a popular hairstyle, and grunge music. When our regulations were crafted, few could predict the extent to which fire fuels would accumulate in areas of fast increasing home development, with weather patterns materially changing and inflation reaching levels not seen since the 70s or 80s. Our insurance regulations are outdated, and they're causing a mismatch between in the insurance pricing system. As for the second question, what is the current state of the market? The answer is clear. The market is out of equilibrium, and insurers are struggling to match their permitted prices to the riskiest parts of California. California's average insurance premium matches the United States average. Other climate affected states such as Florida or Colorado have much higher average premiums, even though California has much higher costs for repairing and replacing homes. Why should the average homeowner's insurance premium in Louisiana be $850 higher per year than California when it costs so much less to rebuild a home in Louisiana? The answer is that our insurance regulations need to be fixed. California is the only state in the country that requires insurance companies to make rates with loss projections based upon their previous 20 years of wildfire losses. We ask, how do the conditions of 20 years ago relate to today's wildfire hazards? Further, California is the only state in the country that bars consideration of the global market for reinsurance, which is the essential source of claims paying capacity that allows insurers to serve so many households. As reinsurance costs have spiked over the last several years, California insurers could not include these actual verifiable costs in their rates, which has led directly to lessened claims paying capacity and the need to reduce the number of households served. We are literally the lone national outlier on two critical regulations. On top of outdated rules, the rate approval process needs improvement. California law states that any rate application not approved within 60 days shall be deemed approved. The law does not match reality. It is commonplace for the rate approval process to take 6 months or more, with many more than a year. With an outdated formula, long rate approval times, and high inflation, insurers and agents cannot serve consumers across the state. As insurance capacity has decreased, the market of last resort, called the California Fair Plan, has grown beyond responsible limits. The Fair Plan is not a government program. It is 100% insurance industry backed. If the Fair Plan runs out of money, it bills the insurance company for the deficiency with no limits. We are in a race, and that race is between fixing the market or allowing the Fair Plan to drain capital to unsustainable levels. This brings us to the last question, which is what reform options are currently within the insurance commissioner powers? The answer is most of what needs to be done. The commissioner can, with a 5-day emergency regulation, allow insurance rate applications to include forward-looking loss projection models and the actual costs of reinsurance. There is no statutory prohibition of this, and the commissioner already has regulations in place allowing these same factors for earthquake insurance rates. The commissioner could also insist on enforcement of the current statute, which allows for a rate filing to become effective within 60 days. The area least clear on commissioner authority relates to the Fair Plan and what happens if the Fair Plan issues an assessment that impairs or even bankrupts insurance companies. California statute does not address this issue. We are generally supportive of the commissioner's sustainable insurance strategy and look forward to providing feedback as his department publishes drafts of the implementing regulations. I thank you for allowing me to get through my prepared statement. Judging by the previous experience, I didn't think I would, so thank you.
I'm guessing we're just getting started. Commissioner Byer.
So I want to go back to the dialogue about the risk calculation regulation, that is the ability of homeowners to ascertain why they were non-renewed or why their rates increased based on the risks out there. Because an earlier witness said the regulation's in place, but no insurance company has yet filed, and that it's hard, and the witness who just left said it's kind of a bureaucratic maze to get through for people to understand what happened and why. And maybe just a fact question. So how is that rule or that guidance being implemented today? And when do you expect it to be adjusted, fixed, finalized?
The Department of Insurance required each insurance company selling homeowners insurance in California to file their risk mitigation filings in April of last year. And we're all waiting for and every company did. So those filings are just.
How many people of the 1,400 people in the Department of Insurance work on this issue?
Oh gosh, that's a hard one. I do have sympathy for people at the Department of Insurance. They're under incredible strain right now. So it's easy for me to try to second guess them. We hope the filings get done soon, but honestly, we don't know their pace. And companies cannot, of course, move forward with any action without that approval.
So to a broader question, let's assume for the sake of the conversation that the key things that you recommended, and you did a very good job of giving a rationale, reinsurance actual costs, wildfire projections, not just history. Let's assume all those things happen and the numbers justify dramatic rate increases on the order of, I'm going to make up a number, a third, a half, to make homeowners insurance unaffordable for a large number of Californians. What do you suggest then?
I doubt they'll be higher than the FAIR plan, and that's where we're sending people now, right? So we have a terrible system now that's a lose-lose. We have a system that doesn't allow admitted insurance companies to charge the rate level that allows them to be in every community. And then knowing that even if we would allow rates to rise for those admitted companies, they're still very, very likely to be less than the FAIR plan. And so we're sending people to the FAIR plan where no one should want to be. But the only way, let's say we talk about models. I hear a lot of things about models that just are not true. They're not destined to lead to a rate increase. What a model does is a company will say, here's the homes in our portfolio. These are their physical characteristics. This is their home hardening. This is their defensible space. This is their position in an overall community risk situation. And then if the company says, well, we're going to open up in these zip codes that we currently are not active in, that are much riskier and are likely to produce more losses, then yes, a model would say your claims costs are going to go up and you're justified in seeking higher rate levels so you can fund those losses. But to the contrary, if you make a filing saying we're going to pull out of high risk areas, a model would say, well, you get to charge less. All they are is a reflection of the actual circumstances of your business practice. So for instance, with earthquake insurance, I know this is shocking, but the way the department lets companies project losses, they say, how close are your homes to known fault lines? Doesn't that make sense that you ought to project your losses by your proximity to seismic potential? Well, when it comes to homeowners insurance, we say, well, how close you're going to do business to brush or chaparral or trees is irrelevant. That's literally what the regulations say right now. It does not matter. And we think that's just silly. That's not the way companies do business. They look at the proximity to fuel, and then from that, they come to the Department of Insurance and make their case for what an acceptable rate level should be. And we don't think it's a stretch to say the more business that you intend to do near grass or chaparral or forest, the more claims you're likely to pay in the future and the more money you're going to need in your funding system to pay those anticipated claims.
Commissioner Sidley?
So let me build on what you just said, where you can't look at, your model can't look at chaparral, but your employees can. I mean, you can look and say, this is in the Sierra Nevada and there are trees here versus, let's say, downtown Los Angeles. And yet that's where, because that's where I live, that's where I'm seeing homes being non-renewed. And I'm trying to wrap my head around why this is happening if, in my view, and I'm no insurance expert, I'm a novice here who's paying bills, but it just seems to me that those are the people that are actually paying the money that you're using to pay for the claims. So I'm not understanding, and maybe you can explain this, why those homes in cities that generally have by any measure a lower rate of claims or where they're filing for help than these areas where you're seeing catastrophic floods, fires, Malibu or Sierra. So if you can explain to me why that is happening, because I don't get it.
I understand. I'd be happy to try to explain it to you. If you look at, let's say, the action that State Farm took last year, the action they just took is they're actually removing some policyholders from their book of business, which for them has been a terribly difficult decision to come to, because as the market leader, and they are by far the market leader, 21%. And the next largest company is less than 15%. And after that, the next largest company is 6%, right? So you're really talking about a giant company. And they're a mutual insurance company, which is a fancy insurance word for they're a co-op. They don't have shareholders. That's what mutual means, Liberty Mutual, Nationwide Mutual. And so the majority of insurance in California isn't even sold by shareholder-owned companies. They're sold by co-ops. So it's not as if State Farm has to answer a quarterly investor call or anything like that. So they held on for a very long time and they kept growing. You know, at the end of 2016, they were 17% of the market. At the end of 2023, they were, well, end of 2022, they were over 21%, which to grow 1% in California, a state that big, is a giant thing. To grow as much as they did, it's just unthinkable. And so they held on for a long time. But when they finally said they couldn't do it anymore and they announced they weren't going to write new business, they didn't say we're not going to write new business in high fire risk areas. They said everywhere, which means it's a capital issue. It's not a risk issue per se. And when they finally made the announcement last week that they're going to non-renew 29,000 homes, which is a percentage of their overall business, is a small amount, but that's cold comfort, of course, to those 29,000 policyholders. So I don't want to make light of that, but it's a relatively surgical number compared to their overall exposure. They wrote a letter to the commissioner that outlined the situation that they're in. And, you know, I've been at this a long time, as Mr. Nava said, and I never thought I would read a letter from State Farm that mentions the word solvency. Right. So what they indicated is at the end of last year, they had 30% of the policyholder protection fund that they had at the end of 2016. They had gone from over $4.1 billion. So in insurance land, they use a term called policyholder surplus. And all that means is the money that's not otherwise reserved for any other function. So if a claim comes in, you have to set up a reserve that takes away from your surplus. So there's surplus, which is a key indicator because you can only write a certain amount of insurance relative to the surplus you hold, you know, because we want them to be able to pay their claims. And so their surplus at the end of 2016 was $4.1 billion. And at the end of last year, it was $1.3 billion, right? So they're making a decision that's not necessarily fire specific. They're making a decision that deals with a concept called a leverage ratio, which is how much capital do you have versus how much business do you have in force. And this is why this issue of reinsurance has been such a big deal, because when you have a capital or when you have a surplus drain, well, how do you make sure that you can continue to have enough claims paying capacity for the amount of business you have in force? Well, one way you do it is you go around the world and you say, would you like to buy some California wildfire risk? And that's what reinsurance is. It's insurance companies simply selling part of the business they have in force to other people around the world. And then that gives you more claims paying capacity. And that's why they can keep growing. Well, that market's been in disarray. I can assure you reinsurance executives the last few years have not been getting bonuses at the end of the year for how much California wildfire risk do they bring into their business, right? And so those prices have gone up dramatically. And when you have a company, let's say in State Farm situation where they have a surplus drain, the only way they can keep up their claims paying capacity is to go out and get more reinsurance. But if they can't afford it, what should they do? And in the end, they can't maintain that claims paying capacity because they can't afford that reinsurance. They've had surplus drain. So now they're in a position where they have to figure out how to take some responsibility off of their books. So it's not a pretty answer, but that's why you have a statewide impact rather than just in wildfire areas. Did that make any sense? Or
It does at the high level. On the low level, it doesn't make sense because the only way to get revenue is to get people paying in that aren't going to make a claim.
Well, this is interesting though. So in I think it was the state's fourth climate change assessment. It was the first time that the state had an insurance module. They hired Rand, and Rand did a study, and they looked at how has the differential between high risk and low risk changed over time. And I think as Amy was talking about, you know, companies have certainly adopted more technology over the last 10 or 15 years. And they've been much more discerning in high risk versus low risk. And the way these risk segmentation models that we're talking about, which are very different than the probabilistic models that I'm focused on. They're two totally separate parts of the system. But the way risk segmentation markets or models work, they all have to net out to zero. So the higher you charge in higher risk areas, the lower you charge in lower risk areas. And so what the state's climate change assessment concluded was over the last decade, companies have been very successful in increasing the premiums associated with high risk areas, but it's been entirely offset, of course, because that's the way the rules work, with significant decreases in urban areas. So it's not as if money coming from urban areas is just sort of this bonanza that's going to make everything right. They're considerably less average premium in a city like Los Angeles, at least in the heart of the city, obviously not the west side, than you would get in high Sierra communities.
Okay, so let me ask you one other question. Carmen's slide had said that the insurance companies are making quite a bit of money. And I don't know if you were here at the time that she was. So that's not what you're saying. Can you explain to me? I mean, obviously numbers, I won't say numbers lie. I would say that liars use numbers. So why are we seeing, why can Carmen produce a slide that says, you know, California is doing so much better and you're saying that it's a dire solvency situation? What is going on?
I'm not here to criticize someone's misuse of numbers, right?
I'm not saying that. I'm confused.
It's sort of a don't believe your lying eyes situation. If if someone's going to tell me State Farm's having a great time right now, that's an utterly ridiculous statement. Okay. Of course, they're having an awful time. Look at what they've had to do. They have a couple thousand agents that the only way they make money is to sell insurance. They're 100% commission based. And they worked hard to build up these customers, and now they have to say goodbye to a bunch of customers, right? It's not as if this company wants to do that or the other companies who have made different moves want to do that. When I hear the language of that previous speaker, it's almost like she was suggesting there's this cabal and there's this, oh, let's get together and let's leverage this particular moment, as if companies just freely violate antitrust rules, right? I run a lot of meetings and I know what we say at the beginning of meetings. We have an antitrust admonition that we deliver and we take it very seriously. And if anyone strays into any type of prohibited area where they're talking about market practices or collusion, we stop the conversation. Well, nobody really ever does because everyone knows better, right? So this is, it's easy to throw rocks, but each of these companies has its own circumstance. They have their own reasons why they're making their decisions. They have their own capital situation and their own risk concentrations that they're attempting to manage. When they go to the Department of Insurance, it's the most transparent system in the United States. We have the most voluminous and detailed rate filing instructions of any state in the country. We have prior approval. We have price controls in California. Not only that, but we allow private lawyer groups to come in and participate in the system, right? And so it's an incredibly adversarial system with these outside groups. If you haven't picked up from the previous discussion, their view of a discussion is to lecture us and threaten us. Last time I talked with the head of Consumer Watchdog, at least Harvey Rosenfield, he told me to never call him again. He told me to never contact him again, right? We don't have negotiating partners. We don't have respectful conversations. At least with Amy, we can talk with her because she doesn't make her money through the rate system, right? She's much more focused on helping people with their claims, right? But with her group, it's just a different thing. They make money through conflict. They make money through conflict continuing, right? And so we don't have the ability to have a respectful conversation with them as much as we would like to. I wish we did, but they just simply won't engage with us, right? So it's a pretty bad situation. But to say as if companies are making so much money that they want to run away from money, that doesn't make any sense. Whereas when the commissioner was having a workshop on the use of modeling, he had someone fly out from Chicago from Allstate and say, look, if we're allowed to price to risk, if we're allowed to use modeling and reinsurance, which every other state allows, so it's not like we're saying something crazy here. They said, we look forward to making a filing showing how we'll grow. I mean, they went on the record by flying someone out here to say that. I don't know what more people expect.
So I just want to be clear, Carmen, I'm not saying that your numbers were wrong. I am strictly trying to understand why your numbers are so different from what Rex is saying here. And so and I don't know. I am trying to learn, and so I just wanted to make that clear that I wasn't suggesting that. So then let me ask, based on what Commissioner Jones has said, that, and again, I assume there's some exaggeration to this, but in Florida, the insurance companies were getting things that they were asking for, and yet the insurance companies are still pulling out of Florida. So how does that work with what you're saying now?
Yeah, I mean, heaven forbid we'd get a full story. In Florida, 9%. So Florida produces 9% of the country's homeowners insurance claims. Florida also produces 79% of the litigated homeowners insurance claims in the United States. So it's a totally different environment, and their litigation environment there has thrown things out of whack. I mean, to act as if we have all these essential learnings from Florida and that we don't like what's happening in Florida, therefore anything that happened there should be disqualified. That's just lazy. Okay, we know what we can do now, and what we can do now is to quickly allow companies just simply the ability to make a filing using modeled losses and reinsurance. The Department of Insurance doesn't have to approve it. I mean, they have a tremendous amount of power. Do you know that from the commencement of the first pandemic-related lockdown order to 2 years later, the Department of Insurance just on its own decided they were not going to approve an auto insurance rate increase? They just did that. They just did that. Well,
I'm sorry, but I'm under the impression auto insurance just doubled. So
well,
I'm not getting
I don't know about your experience, but I know that for 2 years, the Department of Insurance did not approve a single auto insurance rate increase. That's indisputable. Okay. It is the truth.
Okay.
Right. And so for the Department of Insurance, all we're saying is let a company make a filing. If they don't like it, they don't have to approve it. We know that that's true because they took 2 years and didn't even approve a single auto insurance rate increase. Okay. But what we're arguing about here is simply giving companies the ability to make a filing that then the Department of Insurance still has 100% control over. Now, what the commissioner said is that he's open to allowing companies to make rate filings using modeled losses, forward-looking models, as well as reinsurance costs, but he is going to impose a bunch of conditions on it that no other state does. It's not as if our membership loves that. They think that they can produce accurate rate indications using these two tools, and that there shouldn't be additional requirements attached, because that's not what happens in any other state, but we've been told no. And I think the membership of our organization at least has grudgingly accepted, well, okay, if that's the way it's going to be, we'll try our best to make it. And so what the commissioner has said is that if a company is going to use these two tools moving forward, that they be required to show how their statewide market share that they sell. So let's say a company has 10% of the market share. Then once the Department of Insurance defines sort of what are the areas where they really want protection to make sure that there's available insurance, and they're using the language distressed areas. So they're going to define for us a set of geographic boundaries. We don't know whether that's going to be counties or zip codes or what. We await their requirements on that. But whatever's the sum total of those geographic areas, if a company writes 10% of the market share statewide, they have to write at least 8.5% of those geographic boundaries. In essence, it's sort of an anti-cherry picking concept. And we've accepted that, right? And I think the commissioner's point is if you're going to use these tools, prove to us that you're going to write in higher risk areas. And so we're ready to take up that challenge. And we look forward to the issuance of those rules. Because a company that can come to a regulator and say, here's how we're going to match price to risk. And if you allow us to do this, we'll not only make sure that we have pretty close to our statewide market share in these distressed areas, but we'll be in a position to start depopulating the FAIR Plan. companies are willing to make those filings, but they have to be allowed to. And right now it's illegal to make that filing. All we're asking for is the chance to make that filing. And from there, we're going to have obviously public input, and we're going to have a pretty robust effort at the Department of Insurance through the rate review process. And we'll see. Yes, ma'am.
You need statutory change to do that? Is that what you're saying?
No, not at all. It's just
Well, then the
regulatory
term, I
change.
guess I'm a little concerned about the term illegal, because that's, if it's not, don't need a statutory change, that means you have.
Well, it's illegal in the regulations.
So it's the regulatory issue, though. If you-
Yeah, a lot of people try to make this about Prop 103 and an assault on Prop 103. I submitted an 11-page document in advance of this. I'm not even sure I used the term Prop 103 in that letter. I certainly didn't in my statement. That's not what this is about. Our issues are not about a ballot measure that was passed in 1988. What they're about is the implementing regulations that were crafted a long time ago, back when I worked there. And they haven't changed since. And it's about the culture at the Department of Insurance that has grown up around these regulations. Now, I will say, if we're going to talk about Prop 103, Prop 103 instituted prior approval, but it also said you get an approval in 60 days. And if we're going to treat Prop 103 as the Bible, I don't know why we read out that one biblical passage that says 60 days matters. We're not asking for a free ride. We're not asking for inadequate review. But at some point, when you have generationally aberrant inflation, you can't wait a year for a rate filing. And typically you'll wait a long time. And the people at the Department of Insurance, they're doing the best they can. There's no problem with that. I was there. It's not as if I'm attacking them, but it takes a long time to get through the process. Then the large companies who we represent, they're typically going to get an intervener, right? And then they add, many months on top of it. And typically the only way you're going to be able to resolve that issue is you have to give something off, because they don't get paid if they don't, substantially contribute, right? So they're not going to give up unless they get some haircut off of that. So now you've waited a year, you get a half or 2/3 of what you've requested. Inflation is raging out of control, and then you got to turn around and make another filing. And that's the situation we're in right now. It's very difficult.
I've got Vice Chair Canella, followed by Commissioner Byer.
Yes, thank you very much for being here. I think the more we talk about this, the kind of more ominous it is. So first off,
I've been told in many settings I'm a bummer.
Yeah,
So-
right. This whole subject is, frankly. But so you mentioned, I asked Carmen earlier that if you build in a zone or an area that has a higher rate of natural disasters or risk, I asked if you could charge more, and the answer was yes. And you're saying that is yes.
Yes.
But did you further say that it has to be offset with other, like I don't live in those zones, so would you have to lower what I charge in order to do that?
Yeah, there's a lot of casual talk about the way this system works, but unfortunately, because it's so technical, people don't always get some of the subtleties. So when you go to the Department of Insurance and you make a rate filing, the way the regulations work is you put in every element of what constitutes, a part of an insurance rate. And then that formula called the prior approval formula, which the Department of Insurance has, put together, it produces what's called a minimum permitted earned premium and a maximum permitted earned premium. And that language tracks with Prop 103 that says no rate shall be inadequate, excessive, or unfairly discriminatory. So the Department of Insurance's responsibility is to actually protect the public at two levels. One is against rates so low that they present a solvency problem. Because remember, insurance is a promise, so you have to have enough money to pay your promises. On the other side, no rate shall be excessive. So when an insurance company goes to the state under the current rules, the state will say, okay, under our formula, you're allowed to have a statewide aggregate premium of X on the low side, or a statewide minimum premium of this, a statewide maximum premium of that. Okay. And you can charge a rate that puts you anywhere along that spectrum, right? But that has nothing to do with a single house in your portfolio. That's the way our rules work right now, right? So it doesn't matter where you write, whether your homes in your portfolio are mitigated. That's irrelevant to today's current system, right? So you'll get a permission. So let's say on a statewide basis, a company gets permission to charge $100. And they've got 10 policyholders, so they're going to charge each customer $10 a year. That's the first part. When we get to your question then, well, then how do you figure out how to charge individual persons a certain amount? That's where you start looking at home characteristic, defensible space, community factors. You might say, well, Mr. Canella's house that's a real fire trap. We're going to charge him $12, but Ms. Sidley's going to charge $8. We have to offset it so we only get to $100 on a statewide basis. Okay. So when we talk about these segmentation models, they have absolutely nothing to do with the problems that we're focused on. Because all they're doing is figuring out where we allocate the premium, but we're not looking at the overall aggregate amount of premium necessary to do business in the state of California. So when we hear people say these segmentation models are the key to this issue, they're actually irrelevant to the issue. What's at issue is, do companies have enough money on a statewide basis to pay their obligations? And that's what we have to fix.
Okay. So as far as models go, there's been talk about your groups have these models that they do and they won't share them with everybody else. Is that the case?
No. Under Prop 103, there's a transparency provision that says anything that's in a rate application to the Department of Insurance, it must be available for public inspection. No problem. That's totally fine. And so when you make a rate filing, it goes up to this database and you can search and it's totally transparent. And then when the Department of Insurance, they'll look at your filing and they'll have what's called an objection letter. They'll post it up to this public database. It's all transparent. Interestingly, what's not transparent is the interveners. When they file for petition to intervene, it's not public. I don't even know when a company gets an intervention unless the company tells me. When they have their budget, we're going to want $300,000 for working on this. Totally not public. Well, the only way it's public is we have to put in a Public Records Act request to the Department of Insurance. And if we hammer them every week or every month with PRAs, obviously they get frustrated with us and they tell us to stop that, right? So in any event, anything that's required to be in the rate application is public. The question is, what are going to be the rules for the Department of Insurance for how much they require to be in the rate applications? And they have a difficult task of threading the needle between, you want as much transparency as possible, but at the same time, a lot of these models have trade secrets and intellectual property rights that are very valuable that they have to protect. And so what the Department of Insurance, at least in the draft that they revealed, is they tried to figure out how to have a validation process under an NDA for the model. And then once a model is validated, then a company could use the output from that model and everything would be public from there on.
Okay.
And so, if we don't at least try to protect the IP associated with these models, they're not going to sell these models in California, and then we're not going to be able to do business.
Okay. Last question. It was suggested that the industry, we call their bluff. So what happens? What do you see happening if the so-called bluff is called?
I mean, it's pretty counterproductive. I mean, why would we want to do that? I mean, you see that, but that's the kind of feedback we get, right? We don't have thought partners or negotiating partners. They just kind of threaten us. And, it may feel emotionally good, but it's not really effective. There are circumstances in other states where you see things get so bad that companies have to make terrible decisions. And generally, once the companies do that, then legislators will see, oh, we misread that situation, and they'll go back to the company and say, okay, now we're ready to make some changes so that we can get you back in. That happened in New Jersey in the auto insurance market many years ago. It happened in Massachusetts as well. We'd hate for things to get to that point. Honestly, in what was it, 2007 or 2008, we had a big fight over the California Earthquake Authority, and there was going to be a big capital layer that was going to roll off. And then Treasurer Lockyer, he was doing a bill that was, fairly hostile to us. And finally, I was authorized by a major company to tell then Treasurer Lockyer, sorry, this company says if this bill moves through, that they're going to leave the market. And he said, wow, the proponents of that bill lied to me, didn't they? I'm like, yeah, they totally did. Because there's this sense that California is so big and wonderful and lucrative that people will never leave. Well, California is wonderful that and it's a big market. You can make a lot of money, but California is also a market where you can lose a lot of money. And we saw this in 2009 when Allstate came to the Department of Insurance. They asked for a 6 or 7% increase. They got the privilege of a 29% decrease. And they didn't write new business in California for 10 years. Right. So I don't know why, when we're not asking for anything other than the ability to make a filing for the Department of Insurance to evaluate in a public setting. That's all we're asking. And I don't know why we would get to threats based on that. We're not threatening. We're not saying wildfire is uninsurable. We're not asking for anything other than just let us make a filing for you to evaluate. And if you do, we have companies who have indicated publicly that is the pathway so that they can start writing more insurance in California.
It does seem that candidly, the filing really isn't enough. You make the filing is the first step, but if I make a filing and I'm turned down every single time, you're still not making any progress. So I think it's really the filing plus.
Oh, I'm happy to agree with you there. I mean, the way these
Okay.
filings work is that, so in your filing, you could say, okay, we're asking for this rate level. And right now, companies specify the zip codes where they will not do business. Period. Doesn't matter the condition of the home, because the condition of the home is subsumed by the overall community risk associated with, right? And so in these filings, if a company says, we just want more rate, but we're not going to write in any more areas, I assure you the Department of Insurance is going to say, well, how about no? Right? That's what they do all the time. This is the way these filings work. It's a negotiation. It's not as if the insurance company just comes in and demands something and the Department of Insurance acts meekly. That's not the way this works. There's a bunch of give and take. And that's part of the reason why these rate filings last so, the application process lasts so long, because there's a ton of give and take. You'll have 15 or 20 objection letters that are filed during the course, of a filing. So if the Department of Insurance doesn't like a filing that a company is making, we know that they can reject it. We know that because they took 2 years and they didn't approve any auto insurance filings, even though they were righteous, they didn't approve them. So there's no doubt about it that you would hear from, whether it's Consumer Watchdog or others, if a company just comes in saying we want more rate and there's no benefit for the consumer, they're going to say that. And the Department of Insurance people are probably going to say that too.
Commissioner Byer. You may.
I'm done.
So many red herrings in so little time. I want to go back to Chair Nava's question about the size of the premiums collected for homeowners insurance in California. Can you give us a number? What's the magnitude of
the overall insurance premium? I don't have.
Is it $1 billion? Is it $10 billion? What's?
Sure, it'd be hundreds. I don't know. I mean, it's a public
Okay.
number.
Well, I guess what I'm
what you're
trying to
trying to
get at
accomplish.
is we have to fact find. And one of the things that was said earlier was that insurance companies don't make their money just on premiums. They rather make it on investments. And so what I'm trying to piece together is how much money do they have to invest? And both, you made an important point about inflation, which is at a historic level since the late 1970s. But the market, stock market, for example, has doubled in recent years. So I'm kind of wondering how the insurance industry has been able to offset the increased cost of rebuilding by getting increased benefits for their investments, which is why the number of the insurance companies are getting is relevant.
Well, I'm glad you raised this red herring issue. You should definitely consult the insurance code and see that the more investment income a company makes, the less rate it can charge. That's in the text of Prop 103. So it's not as if investment income is irrelevant to permitted rate level. There's a push and pull. So if the suggestion is somehow, boy, there's all this investment income in it, and yet these companies are still charging these exorbitant rates, that's just not the way the system works.
Okay, so what you're saying, and what I'm going to suggest to staff for a subsequent hearing is I think we need testimony from someone who represents reinsurers. And I think we need testimony from someone who is intimately familiar with insurance, the insurance industry, how it functions. Because I'm sure Rex doesn't want to stay here with us till dinner. And
Hey, I'm game.
yeah, well, not if you saw what we get to eat. But then that can give the commissioners a broader understanding of the industry. So for example, Mr. Frazier made reference to it's a mutual insurance company as compared to, I suppose, a shareholder-owned insurance company and other models of insurance carriers and how the rules apply to them.
The same.
And I'm sure that there is language specific to the insurance industry that I am, unfamiliar with, and that other commissioners are unfamiliar with, that will help us get a better understanding of the nuance, because there's a great deal of nuance the way I understand what we're talking about.
For sure. But I do urge you to consider there's two regulations where we're simply one of a kind in the country. And if we fix those and allow companies to make filings with modeled losses in reinsurance, companies are going to come to the Department of Insurance and make those filings. And the Department of Insurance is going to demand, how many people are you going to take out of the FAIR plan? What high-risk communities are you going to go back into? That's what we need to do. And I'm happy to talk about any detail you want, but that's the essential issue here. It's within the Department of Insurance's power to change these regulations and just allow us to do what we do in truly every other state and be permitted to make a filing that the Department of Insurance can then criticize and reject or say, we don't think it's good enough and we won't approve it unless and until you do more.
Yeah, I mean, I think you've given us a partial explanation for some of the questions that Commissioner Sidley raised, which is that using, either drones or zip codes or whatever it is, an assessment is made with respect to the risk within an entire defined area. And because of that risk assessment, you may have a home that doesn't have the characteristics of other homes that are considered high risk, but that doesn't do you much good. And I'll give you, part of we all understand, those of us that have been elected officials, and I think all the commissioners too have experienced it, is the perception often becomes the reality. So when I hear from a homeowner that they got a non-renewal notice and they contacted their agent, right? And let's not forget the agents for them.
Exactly.
These are the folks that are getting beat up over the phone or having people show up at their offices and having to deal with homeowners who are frustrated and angry. I mean, they ain't going up to corporate. They're going to their neighborhood agent who sold them the policy. And in this particular instance, this homeowner was told that the non-renewal was based upon drone footage that showed a tree that overhung a part of their property that posed a risk to either the home or the garage or whatever it was. So the homeowner says, I'll chop it down. And the answer is, doesn't matter. Now, part of the explanation, it seems to me, is what you've told us today, that the decision was made on an area. And this person's home, I suppose, was in an area, right, where an assessment was made that we're not going to write any more policies in this area.
Correct.
But for that homeowner, all they know is, I'm prepared to do everything I need to do to eliminate what you have just told me is the risk. And you've just told me it doesn't matter.
Yep.
Now, I don't want to be in your position, right, to have to defend that, although you kind of are. And I just can't imagine how the agent, who you rightfully indicated, makes their living and supports their family by writing policies so they get a portion of the premiums, how they get to explain to that homeowner who maybe they've been paying premiums for 25 years.
Yeah, we wouldn't be having those conversations, though, if we would just fix the regulations, right? That's the problem here. We keep having these discussions at the homeowner level, but that's not what is driving this issue. And when we talk about these segmentation models, they're not what is driving this issue. What's driving the issue is companies, if they cannot make enough money on a statewide basis to serve every community, then they're going to have to be more discerning in which communities they can serve, period.
Yep. All right. Understood. Thank you for that. Let me turn to fellow commissioners to see if they have any other questions, comments. Seeing none. No, Mr. Frazier, you managed to hypnotize all the commissioners.
Well, hopefully it wasn't too much of a bummer today.
No,
but,
no, well, no. I think this is an important contribution. And I think it's part of the value of the Little Hoover Commission is to have the opportunity to, start at 10 and take testimony until 1 and then do 2 or 3 hearings to actually begin to peel the onion to get to what is the core of what's going on. And I think it's clear to us that you've identified from the industry's perspective those aspects of California's regulatory process that you believe if cured in the definition that you pursue would eliminate many of the problems that homeowners face. We get to hear from others who may disagree perhaps with what you've identified as the critical choke points.
Yeah, if I may just close with, in the short term, this is the solution, but obviously it's not the long-term solution, right? We can't just have indefinite rate increases, and we're going to have much more difficult conversations than we're having now about how we sort of bend the cost curve down, because what's going to happen ultimately, because the science is not yet done when it comes to effective community mitigation. If anyone tells you it is, that's just not true, right? At this point, there are no metrics for, hey, community X, if you reduce X% of the fuel here, then everything will be better. And so the insurance industry is one of the largest funders of that type of research, and that research is ongoing right now. But when we get to the point where companies are able to incorporate into their methodology community scale mitigation standards, and homeowners associations and community elders and city councils and others are going to then know exactly what it takes to bend the cost curve down, I think those discussions are going to be way harder than they are now, because you're going to be telling a community that likes the way that community is presently configured, particularly if it's in a nature area, that they're going to have to take some fuel out. And I think that's going to be terribly difficult.
Yeah, well, and I think former Commissioner, I just call him the Honorable Dave Jones, was making that point first thing this morning, that there's a bigger picture here that we're going to have to deal with to get to the underlying issue. Otherwise, you're right. The premiums will continue to escalate until it just becomes ludicrous.
That's right.
All right. Thank you, Mr. Frazier. Now, at this point in the hearing, we're normally open for public comment. We have been at this since 10 o'clock. I kind of wonder whether commissioners would like a bio break before we lead into public comment. You take a bio break, pick up your lunch, come back to the dais, and then take public comment. Is that acceptable? Yeah, it looks by I see unanimous, other than Commissioner or Vice Chair Canella, who already ate his lunch, just so long as he doesn't eat mine. So we're going to take a brief bio break to allow commissioners to get up and go pick up their food and come back, and then we'll proceed with public comment. We'll get the right agenda. All right. Hello, everyone. The commission took a brief break so that the members could get their lunch and then come back to the dais. I'm going to have to make a change to the order in the agenda, in part because commissioners have travel arrangements that they have to observe. And normally, we would start with public comment during the business meeting, which is what we're doing presently. But instead, in order to ensure that we have the maximum number of commissioners present, I'd like to move item number 4, which is the commission elections, up so we can take that now. Under our rules, the rules call for election of officers in person in Sacramento in March of each year. And so I apologize to those who are waiting for public comment, but this is something that I think we need to take up. And after we take up the elections, then we'll move to public comment on the regular agenda. Let me turn this over to you, Ethan.
In that case, Mr. Chairman, we will go to item 4. And 4A is the election of the chair.
Open for nominations.
I'll nominate Pedro to continue to serve as president and chair.
There's a motion and a second. Thank you. Any further nominations?
Acclamation.
Seeing no further nominations, call the roll, please.
Thank you. Mr. Chairman?
Aye.
Mr. Vice Chair? Commissioner Arner? Commissioner Byer? Assemblymember Chen? Commissioner Garcetti? Commissioner Hernandez? Commissioner Johnson? Senator Min? Assemblymember Ortega? Commissioner Sidley?
Yep.
And Senator Wilk. Congratulations, Mr. Chairman. The motion passes.
Well, thank you. Again, I appreciate your confidence in my work with you as chair, especially since it may very well be this is my last year.
Oh.
Yeah, my appointment, this particular appointment expires at the end of 2024. So thank you again for your trust and your confidence. Next, we have the election of vice chair. Nominations are open. What? Commissioner Sidley has raised her hand.
I'll nominate Anthony Cannella to continue to serve as the vice chair.
I'll second it.
There's a motion and a second. Any other nominations? Hearing none. Roll, please.
Mr. Chairman?
Aye.
Mr. Vice Chairman? Commissioner Arner? Commissioner Byer? Assemblymember Chen? Commissioner Garcetti?
Aye.
Commissioner Hernandez? Commissioner Johnson? Senator Min? Assemblymember Ortega? Commissioner Sidley?
Yep.
And Senator Wilk. And that motion passes as well, Mr. Chair.
Thank you. Vice Chair, do you have any comments?
Thank you very much. I'm very concerned about the end of this year. So
thank you, commissioners. Much appreciated. Let's go back now to the prior order of our agenda.
Thank you, Mr. Chairman. So we will begin with public comment in the room, and then we will take public comment from anyone who is online. If you are online, and I'll ask the staff to put up the instructions on Zoom, but if you are online and you've joined by Zoom, please use the raised hand function to indicate you wish to make public comment. If you have phoned into the meeting, email us immediately at littlehoover@lhc.ca.gov. Give us your phone number so we know who to unmute when you are called on. But it's much preferable that you use the raised hand function if you can. And public comment will be limited to 3 minutes per speaker, as it normally is at commission meetings. And we will start with people in the room, although I believe, Mr. Chairman, that Commissioner Sidley is trying to recognize.
I just want to clarify that this is public comment on any of the items on our agenda. This is not limited
Correct.
to what we just heard for insurance.
Correct.
I just
correct.
wanted to make that clarification.
Correct. Members of the public can make public comment on any item at any time, and this is the time to make public comment on any item on the agenda. Thank you for that clarification. So we'll begin with people in the room. Again, you're limited to 3 minutes, please. And people in the room can use the podium right behind me. The first person to request public comment this morning was Rex Bone. Mr. Bone.
Welcome.
Thank you. Was that 3 minutes on each item or 3 minutes combined? Just point of clarification.
3
Okay.
minutes total, yeah.
I'm only commenting on one. I have people ask that all the time. Thank you. Hi, I'm Rex Bone, County Supervisor from Humboldt County. 80% of our public forests lie in rural lands. I'm part of, I'm a rural county. We're about 6 million plus acres. 80% of it is public lands. They're a terrible neighbor to have for fires because that's where a majority of the fires come from. But with that being said, there's a couple things we need to do. With 1,400 people at the Office of Insurance, it should take about 5% of them and put a mitigation plan together in case we have an insurance catastrophe. And how are we going to deal with that? Because that looks like we're headed, because I really have never been more confused. I thought I had this all understood until I heard the last 4 speakers. And they pointed their fingers at each other and nobody would take blame. And the problem is somebody's going to have to take some of these efforts. Some of the problem is we're in California, twice the building costs of Texas and Florida. Keep that in mind. That's a lot why insurance companies don't want to do here, because the replacement costs. They'll give a value. They'll insure you for $300,000. They don't want to insure you for a replacement cost. Fair plan. As we all heard, it's not. And then you have to buy another plan to go with it. And there was a lot of talk about the earthquake. Humboldt County is known for fires, floods, and earthquakes. We had 3 people in our whole county that had earthquake insurance. We have 138,000 people. So it seems to me it's not a very good plan because they're not flocking to it. And if they're planning on making money off Humboldt County, they're not. We need more opportunities to support vulnerable homeowners. Hardening is the main thing. Reward people. You keep saying this, and we keep saying they drone it and everything else. We're at a point now where we can, 20 miles high, we can get a license plate. So we can start spotting these houses. And with AI and with this technology, you don't need somebody doing it. They can tell you if the house is a problem or not. But we should reward the people that are putting the effort forward somehow. Make them send in a video, make them send in something that they've done these things. But we're going to have to do it. We've talked about it for 20 years now, but now it's got to a critical point. People, I had an 80-year-old woman call me the other day. She is about to lose her house. She picked up 3 more Tai Chi classes. She's teaching 8 Tai Chi classes a week so she can stay in her house. So as Gil might be taking one of them because she would be the next oldest person in the room if she was here. So what I'm saying is we need to find some answers to do this. This is getting to be, rural counties we always get the brunt of it. We're getting the brunt of it now. And we don't, was that 3?
Yes, if you can wrap up quickly, please.
Anyway, I appreciate the time. I've got to drive back to Humboldt County and catch my grandson's first Little League game tonight. But I appreciate you taking a quick lunch and bringing it back to take this. But there's some tough things in, but the Office of Insurance has to step up and figure out a way, because we're getting to the insurance cliff. So I appreciate your time, efforts, and you guys decipher what the last 4 people said. Thank you very much.
Thank you.
Thank you, Mr. Bone. Next we have, and I am no doubt mispronouncing the name, my apologies, John Amodio, I believe. Am I close?
You were close. I've heard it worse. So
Okay, please go ahead, sir.
So yes, my name's John Amadeo, and I serve on the leadership team of the Yosemite Stanislaus Solutions, community-based collaborative of over 30 diverse entities working together in achieving wildfire resilient forests. We are definitely on the cutting edge of the problem.
Could you pull the microphone down so we can?
And I believe we are on the cutting edge of the solution. The original mega fire, the 250,000 acre rim fire in 2013 occurred in our area. We have a decade of learning as to what is needed to succeed in restoring wildfire resilience, which is the most economical way to addressing our current insurance crisis. Here are lessons that we have learned relevant to the insurance crisis caused again primarily by megafires. The science is clear that megafires will grow in frequency and in destructiveness unless we invest as soon as possible in the proven treatments that reduce wildfire intensity and magnitude. Research scientists now foresee the worst of our wildfire years up till now will become more like the norm without such investments as soon as 2030. Current combination of decreasing availability of private insurance and increasing of reliability on the FAIR plan is a prescription for undermining the basic viability of communities, not only at the rural level, but over time, the majority of California increasingly susceptible to megafires. Megafires have already caused staggering destruction in population areas long considered safe from wildfires. Current focus seems to address mostly on one half of the needed solution, how to build sufficient reserves to pay off increasing losses. Yet the findings of research scientists and economic experts document that the only path to reducing overall wildfire impacts, including on homeowners insurance, is making the needed long-term investments to reduce intensity and magnitude of future wildfires. This includes wildfires in California's vast chaparral areas, such as the Inland Empire, where Santa Ana winds pose potentially the greatest potential wildfire loss to property and lives. As it took 100 years to create this crisis, it will require dedicated multi-year funding to reverse this. Our current boom and bust state funding is a guaranteed path to failure. Therefore, please include the need for California to make the essential dedicated multi-year investments in reducing future wildfire risk. Otherwise, we are only delaying a cascade of catastrophes that collapsing homeowner insurance would achieve. Of course, the key question is, then who pays for these needed investments? The truth is that everyone will need to pay. The challenge is to establish an integrated package of equitable funding sources. While no one, such as the insurance industry, should disproportionately contribute, everyone, including them, need to be part of any viable solutions. Thank you very much.
Thank you, Mr. Amadeo. Is there anyone else in the room who wishes to make public comment? Seeing none, we'll move on to people who've raised their hands online, wish to make public comment. Shara, if you can identify the first speaker.
Yes, this first speaker is going to be Janice Parvin. Janice, you now have the ability to unmute yourself.
Thank you, Chair Nava and Commissioners. I'm Janice Parvin, Ventura County Supervisor. I have been receiving calls from residents in our county that will be losing homeowners insurance on July 3rd. It has been reported that the State Insurance Commissioner, Lara, is working on an insurance strategy or regulations that have not been updated in over 30 years. How possible is it to expedite changes and getting them approved by the state prior to the July 3rd deadline? That is the deadline for 72,000 properties statewide insured by State Farm alone. And we're really running out of time. It's a serious concern here in Ventura County, and I'm sure it's a serious concern to every homeowner in California. Thank you.
Thank you. Our next public comment will be from Dore Bietz. Dore Bietz, you now have the ability to unmute yourself.
Ma'am, if you can go ahead. Is she unmuted, Shara?
I'm going to go ahead and ask to unmute.
Is she muted on her end?
Yeah.
Ma'am, you're Dore Bits, I guess it is. You are muted on your end. If you can unmute, please, and begin your comments. You can please unmute. If not, I think, Shara, we can go on to the next speaker.
Okay, our next speaker is going to be Ann Cottrell. Ann Cottrell, you now have the ability to unmute yourself.
Good afternoon. Can you hear me okay?
We can.
Yes.
Great, thank you. My name is Ann Cottrell and I am a Napa County Supervisor. Great.
Oh, I'm sorry, one moment. That was me, my apologies. Anne, please continue.
Ms. Cottrell, I'm so sorry. We briefly muted you, but go ahead and begin again, please.
Great, I'll take a second chance. Thank you. My name is Ann Cottrell and I'm a Napa County Supervisor. I wanted to say thanks to Supervisors Bone and Parvin for their comments as well, and to the Commission for addressing this critical issue. And I wanted to thank Amy Bach at UP. She and her team have been very helpful to our community in providing really practical solutions for residents seeking insurance, working with insurers and hardening their homes. As a county supervisor, we've faced really high wildfire risks and seen draconian impacts. And we've already implemented many community wildfire protection projects, including defensible space, fuel mitigation, roadside clearance, dozer lines, and many more. And now is the time for the insurance companies to catch up with all we've done working together. So I'm asking you to hear that we really need premium reductions and credits for the actual on the ground risk reduction work that has been done. On a positive note, I would share that we've seen one community who's received certification as a fire safe community see some discounts in their rates. So I'm thankful that the insurers have been responsive. And my final point is a vote for transparency. One of the commissioners mentioned the black box of rate setting and underwriting processes. And while catastrophic models make sense in this age of climate change, we really need, as a public, more insight into how those models are being used and the underwriting process in general. So thank you for hearing my comments and that vote of transparency.
Thank you. Our next speaker is going to be Chris Gallagher. Chris Gallagher, you now have the ability to unmute yourself.
Thank you, Commissioner, and the other guests that have been online today. I'm Chris Gallagher. I'm a Lassen County Supervisor, and I appreciate the input that the 3 other rural county supervisors have put in on this particular webinar. We get constantly asked, I guess, in our county about why people are being canceled on their insurance over and over again. I can tell you personally, I have 2 properties in Lassen County. I've been canceled 5 times, and I have the FAIR plan now. And I don't know if you know, but there's a number of retired folks that have had to cash in their entire savings in order to pay off their house, their home, because they had mortgages and needed to have insurance with their mortgage. And now they have no savings, but they don't have to pay insurance for fire. So this is a really critical issue. And I would love to have in one of your parts, upcoming parts of this discussion, to have counties be able to come and give some presentation as well, because I think there are issues that are being missed. You know, we had the Dixie Fire here in 2021. We lost all of our timber industry in Lassen County probably 20 years ago, and I think the timber industry ought to be involved in this conversation as well. So I appreciate the commission taking on this topic. We've been trying to get a hold of Commissioner Lara and have him come and talk with us, and that's been a failed effort. It's just unfortunate that one of our representatives in the state will not come and talk to their county representatives. So again, I thank you. I hope you will invite county supervisors to come and speak in the future at a longer period of time than 3 minutes and discuss some of the issues that we're having in our counties. So thank you once again.
Thank you. Our next speaker is going to be J.P. Rose. J.P. Rose, you now have the ability to unmute yourself.
Good afternoon, Commissioners. My name is JP Rose, and I'm the Policy Director in the Urban Wildlands Program at the Center for Biological Diversity. Today, I'm asking you that you postpone finalization of the Commission's draft study on the California Environmental Quality Act for 60 days. Postponement will allow the public an opportunity to carefully review the draft and provide comments, and allow the Commission time to review and consider them at a future meeting. Upon initial review, it appears that there are some recommendations in the draft report that could have troubling implications for CEQA and for the ability of communities to engage in the land use decision-making process. If we really want to find solutions to the affordable housing crisis, we should focus on the real causes, such as real estate speculation, inequitable zoning, and unregulated short-term rentals. An equitable and climate-resilient future for all communities requires a stronger CEQA. Thank you for your time and consideration.
Thank you. Our next speaker is going to be Christina Caro. Christina Caro, you now have the ability to unmute yourself.
Good afternoon, Commissioners. Are you able to hear me?
Yes, we can.
Wonderful, thank you. Good afternoon, Chair Nava and Commission members. My name is Christina Caro. I am speaking on behalf of the State Building and Construction Trades Council of California. I am commenting on business item number 3, which is the Commission's proposed consideration of the draft report on CEQA. The State Building Trades represents nearly 500,000 working men and women, including many members and apprentices from underrepresented communities who rely on the CEQA process to protect their communities, their own personal health, and the health and environment of their cities. We participated extensively in the 2023 process the Commission held on considering the effects of CEQA. We submitted comments which identified major flaws and a lack of evidentiary support for several of the CEQA topics that were addressed in the report. We reviewed the draft report that was provided just 2 days ago to the public and asked that the Commission continue this hearing in order to allow the public time to consider and weigh in on the draft, and also to make substantial revisions to the report. Some of the issues that were raised by both State Building Trades and many other members of the public included initial proposals for limiting standing based on motives rather than the public interest, which is inconsistent with California law and the Constitution. Unsupported testimony from developer advocates that CEQA is a factor in the state's housing crisis, when in fact, substantial public evidence demonstrates that CEQA is not a barrier to housing. We also urge the Commission not to recommend any changes to CEQA that would jeopardize its environmental and public health protections or restrict the rights of the public. Unfortunately, the draft report does exactly the opposite. The report includes recommendations aimed at curtailing public participation by limiting standing and by prohibiting public comment outside of the CEQA public comment period. This would infringe on fundamental rights of free speech and association under the Constitution, and would create legal violations that would have to be resolved with additional litigation by preventing members of the public from submitting evidence to agencies in order to exhaust administrative remedies. The report also proposes unsupported exemptions and fails to consider several of the key proposals that were made to strengthen CEQA, such as recognizing environmental justice and identifying human beings as part of the environment. So the State Building Trades would like to urge the Commission to continue this hearing and also to please revise the report to remove the improper recommendations and blanket CEQA exemptions, and to refocus it on recommendations that preserve CEQA's substantive and procedural mandates that would best fulfill the purpose of this proceeding, which the Commission is charged with, which is to consider how to best ensure that any changes to CEQA preserve environmental protections and public accountability. Thank you very much.
Thank you. Our next speaker is going to be Michelle Bushnell. Michelle Bushnell, you now have the ability to unmute yourself.
Hi, good afternoon. I want to make sure you can hear me.
Yes, we can.
Thank you. My name is Michelle Bushnell. I'm a Humboldt County Supervisor. I want to say thank you to my fellow Supervisor Rex Bone, who was in the room, and then also to the supervisor comments that have happened previous. I'm speaking about the insurance, fire insurance. And I just want to say, you know,
Michelle, we can no longer hear you. Can you unmute yourself?
Bushnell, I believe you muted yourself, perhaps? We did not mute her, correct? Ms. Bushnell? If you can unmute yourself, we can no longer hear you. Okay, Ms. Bushnell, I tell you what, we'll move on to the next speaker, and then Ms. Bushnell, if you can unmute yourself, you can always raise your hand again and get back in line, I suppose, and we can continue with your comment. But in the meantime, so as to save time, let's go on to the next speaker, Sharon.
Okay, our next speaker is going to be Doug Karstens. Doug Karstens, you now have the ability to unmute yourself. Doug Karstens.
Thank you. This is Doug Karstens. I want to check if you can hear me, please.
Yes, we can.
Well, thank you and good afternoon, Honorable Commission. My name is Douglas Karstens. I am an attorney with Karstens, Black and Mintier. I would like to provide comments regarding item 3, the proposed changes to the California Environmental Quality Act, which is California's premier environmental law, a Bill of Rights for environmental democracy. I had the honor and the privilege of being a panelist before this commission on April 13th, 2023, to provide comments about the proposed changes, and really appreciate the hard work and thought, both of the commission and your staff. Very excellent work to staff and yourselves. I have to commend that. I'd like to note we submitted subsequent letters, myself and the Center for Biological Diversity's Aruna Pravala, on October 27th, 2023, and also on December 21st, 2023. I understand from staff that one was received, the other one was received more recently, but at least both can be considered. And as you consider changes to the California Environmental Quality Act, first of all, I would join the comments of the Center for Biological Diversity and the state building trades requesting that this commission give another 60 days for the public to weigh in. Realizing that that may not occur, I'd like to note a couple of things. First, the framework for evaluating any changes that we would encourage, strongly encourage, is remembering the purposes of CEQA are public participation and environmental protection. Anything that you do, any recommendations you follow are either going to improve public participation in environmental protection, or they are going to detract and destroy those values. What you have in a couple of the recommendations are things that will detract and erode public participation and environmental protection. Specifically, 2 recommendations. One of them is for creating standing requirements that are similar to the federal government's zone of interest requirements. This is an idea that was considered and rejected by the California Supreme Court in a case called Save the Plastic Bag Coalition. I sent a citation to it to staff. A quote from that case said, "There are sound reasons to be cautious borrowing federal standing concepts born of perceived constitutional necessity and extending them to state court actions where no similar concerns apply." That's a reference to federal Article 3 standing, which does not apply in California. Restricting standing is just locking people out of the processes and public participation. I encourage you not to do that. The other comment we have is about the what you and staff refer to as late hit. It's not hits. Public comments are concerns of the public. I call them 11th hour comments. They're not data dumps. These are comments from members of the public who may have only received notice very.
Mr. Karstens, if you can wrap up fairly quickly, your 3 minutes has expired. So if you can wrap up quickly, please.
Thank you. I just appreciate your time and consideration. We've submitted this in writing, and thank you for your careful work on this. Thank you.
Thank you. We're going to go back to Michelle Bushnell. Michelle, you should have the ability to unmute yourself.
Can you guys hear me?
Yes, we can.
I am so sorry. I don't know where I got cut off at. I wanted to thank my fellow supervisor Rex Bone, who is in the room. My name is Michelle Bushnell. I'm Humboldt County Supervisor. I think that you heard some of what I said. I also would like to thank the supervisors in other counties. I'm talking about the wildfire insurance issue. And I just would like to leave with a couple thoughts on how can county government be helpful? There is a lot at stake, and we know the commission knows this is important to us, but what can we do to help? Also, when does the commissioner expect to release the next round of insurance rate plans, including the safe from wildfire discounts? Does the commissioner have the authority to structure how the insurance companies work with safer from wildfire programs? It is all something or nothing. Some of these ideas are easier to implement, others are not. Can the commissioner direct the insurers to approach it as an additive process where credit is given for what is achieved? Also, just want to say, you know, in my county and other counties, it's a really sad state when retired folks have their homes paid for yet can't afford the California Fair Plan, and so they're choosing to have no insurance. Should fire consume their home, this retired population will be end up homeless in many counties, and it's more prevalent than you would think. The amount of people that are not able to afford the California Fair Plan, and also insurance companies in the middle of a town with cement entirely around a home are using a decorative tree in the back of their homes to cancel insurance. And so I would just really echo what already has been said by county supervisors and by my fellow supervisor Rex Bone. Thank you, and thank you for your time today.
Thank you. Our next speaker is going to be Emma. That's first name only, and it's Emma. You now have the ability to unmute yourself. Looking for Emma.
Hi. No, thank you for letting me have this opportunity to speak. Thank you, Commission, for bringing this to the attention or bringing this to, you know, our attention to be able to discuss this, because when I reached out to Commissioner Laura's office, they dismissed me. When I reached out to local representatives, they dismissed me. And I own my home. And I was given a notice last July that it would be non-renewal, that the company was no longer doing business in California. When I reached out to other agencies, they were not taking in new applicants. And so I know I don't have insurance on my home. If it burns down, we're homeless. And that shouldn't be the case in California. As far as the FAIR Plan, that won't work for us either. I live in Fresno County. I'm not in the mountains. I'm not in high risk area. I live right near a Fresno City College. So there's no reason why my home should be at risk. There's nothing around here. One of the things for the second insurance was, well, your roof probably needs to be renewed. So if you do that, maybe we'll do that. And so, okay, well, there's $10,000 I don't have. So how am I going to get insurance? There's nothing to help me. And Commissioner Laura's office dismissed me. My local elected representatives dismissed me. So thank you for bringing this to attention. I'm hoping now maybe someone will start doing something. And again, thank you very much.
Thank you. We're going to go back to Dory Bietz. You now have the ability to unmute yourself.
Hello, can you hear me?
Yes, we can.
Awesome. Thank you so much. And apologies for that earlier. Good afternoon, and thank you for the opportunity to comment. My name is Dory Bietz, and I serve as the Office of Emergency Services Assistant Director for Tuolumne County. I also have represented rural counties on the California Risk Modeling Work Group, and I serve as the direct staff support to Tuolumne County Board of Supervisors Fire Safety Advisory Committee. Tuolumne County is a forestry and tourism-based small economy located in the foothills of the Sierra Nevada mountains, and like many rural and most counties, is concerned with reducing loss of life and property from catastrophic fires. Most of Tuolumne County is located within the very high fire severity zone, and we know very well the impact it has had on our community and in the increased insurance premiums. It is not uncommon for residents of our county to receive non-renewal notices for insurance providers or to see our insurance premiums triple in cost. In fact, Tuolumne County has one, if not the highest number of residents in the state on the FAIR plan. Last year, 30% of homeowners within our county were on the FAIR plan. We are also seeing many homeowners who own their homes outright choosing not to get home insurance because it is simply too expensive. This has led to a large number of residents who have opted out to go bare or to be uninsured. For the retired and elderly, this could be catastrophic and could leave many homeless. New homeowners cannot buy homes because the insurance rate is much too high or unavailable. Many of our homeowners are in a panic and desperate to find a solution. As a county, we have taken great measure and invested millions of dollars in fuels reduction projects, promoting and ensuring that our communities have defensible space, as well as promoting fire-wise communities, which would empower those residents to work together in creating wildfire resiliency throughout our county. Working together to be wildfire resilient should pay off and considered in any modeling. We are also excited about a home hardening pilot project and hope that we can encourage homeowners to invest in decreasing their risks through investment in hardening their homes to reduce ember ignition, all of which should be rewarded through insurance premiums. Our general comments regarding new regulation. CAP models can be used to estimate the value of mitigation features, which can be reflected in insurance prices, inducing homeowners and communities to take actions to reduce the risk to their properties. Factors should not be just historic, structural, or topographic factors or fire history, but the action homeowners do in addition to changing the construction of their home, being a member of a fire-wise community, having defensible space, reducing hazardous vegetation, the work their community has done in fuels reduction alongside roads or within their own property, all of which has proven to reduce risks. Reducing risk should lower the vulnerability component of any CAP model. Wildfire modeling is not without its limitations. While it can provide valuable insights into the future wildfire risk of an area, it is an inexact science. Many variables can impact the accuracy of a wildfire model, including the quality of data input and the complexity of the model itself. Data should be verified and looked at regularly to allow for accurate information.
Ma'am, if
New
you
events.
can wrap up, your
Yep.
3 minutes has expired. If you can
Perfect.
wrap up quickly, please.
Awesome. In closing, we echo comments that communities that invest in reducing wildfire risk should be rewarded, and the work that property owners do to reduce risk on their individual properties should be reflected. On behalf of Tuolumne County, we encourage continued transparency and public outreach to review the availability of homeowners insurance in the state and assess current strategies to regulate the homeowners insurance market and explore additional policy solutions. Tuolumne County is grateful for the opportunity to engage in shaping local perspectives as the state progresses toward enacting insurance reform, and we thank you very much.
Thank you. We have no more public comment.
Thank you very much, Sharon. I'll ask one more time. Any other people in the room wishing to make public comment? If not, I think we can close that agenda item, Mr. Chairman. That technically speaking, the next item on the agenda is the business meeting minutes. I wonder if, given the press of time and the need for commissioners to travel, we should just skip that and take that up at a subsequent meeting?
I think this will take 30 seconds.
Okay, all right. In that case, approval of the business meeting minutes from February 8th.
There's a motion, there's a second. Any discussion, changes? None proposed. Take roll, please.
Mr. Chairman?
Aye.
Mr. Vice Chairman, Commissioner Aaroner, Commissioner Byer, Assembly Member Chen, Commissioner Garcetti,
Aye.
Commissioner Hernandez, Commissioner Johnson, Senator Min, Assembly Member Ortega, Commissioner Sidley,
Yes.
Senator Wilk. Motion carries, Mr. Chairman.
Thank you. Minutes have been approved. Next item.
So the next item, Mr. Chairman, is consideration of the draft report on the California Environmental Quality Act.